I think we're in the midst of a massive AI opportunity.
What we're seeing in financial markets, it's just much more about this AI theme.
The story clearly within tech is semis.
We're very constructive on the market. We still think this is a risk on tape.
I think the market's generally okay.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Where did the weekend go? Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday, oil pushing higher. The president unimpressed. Ruling Iran's proposal totally unacceptable. A setback for the ongoing diplomatic effort sending oil back towards 100, failing to derail the equity market rally following 6 straight weeks of gained stocks holding on to record highs.
So we just saw the longest streak going back to late 2024 with semis leading the charge as well as big tech. This is an incredibly narrow rally, which is the reason why an increasing number of people have raised questions about whether things are getting a bit frothy, divorced from reality. The fact that we're seeing oil prices up, but the Kospi also up, flying this morning in pre-market trading gives you a sense of just how separate these two stories truly are.
Chris Ferrone put it well in the last week on this program. This is not a consumer-driven rally. This is a tech-driven rally. Lori Calvasina over at RBC, new price target. 12 months out, 7,900. Ed Yardeni, new price target, year-end, 82.50. 5% move on semis Friday, 11% move just last week. Things are starting to build and build very, very quickly.
And Lori frankly talked about how you want the growth. You do not want to go, say, to some of the more vulnerable consumer-facing stocks. So here is the question. What's the litmus test for when things are getting over their skis? At what point do you think that people are over-investing? At what point do you need to see some sort of sea change in the narrative for this to sort of temper itself? That's what people are looking at right now. And frankly, they're saying still buy. So right now, going forward, I think it's going to be really compelling on May 20th, 5 years later, when NVIDIA actually reports earnings, what their forward look actually is.
When the earnings don't sound like this, first quarter profits double what analysts expected. SocGen, 85% beat, the biggest beat rate in 5 years. Bloomberg Intelligence, Mag 7 firms expected to post a 57% jump in first quarter profits. It's a rally that's been powered by some stellar earnings.
Which is a reason why people say it's sustainable, because actually the market cap has not expanded as quickly as the earnings growth has. And that's what Julian Emmanuel pointed to in a note over the weekend. That actually earnings growth has outpaced it in a way that we really haven't seen for a very long time. Nonetheless, there are some big questions about the use case. Torsten Slok pointed to this one paper that I thought was fascinating, saying which tasks out there, not only, yes, sure, you can automate them, are cheaper to automate with AI than using a human. And it's actually about a quarter of them that are potentially exposed. So the question of the return on investment is increasingly in focus as people look at what the future of AI truly looks like.
We'll have that conversation in just a moment. We'll also be looking ahead to the week ahead. Coming up this week, inflation data front and center. Put it together. Unemployment close to 4%. CPI could also be close to 4% when it's revealed in the next 24 hours. And the Fed holding on to an easing bias in the face of all of that, which is absolutely astonishing.
Yeah, and this comes as Fed Chair Jay Powell, ostensibly on Friday, that will be his last day as chair of the Federal Reserve. Whether he stays on, of course, remains to be seen, and it really depends on Kevin Warsh. You talk about this, but the easing bias in Wall Street is fading. And you could see this with an increasing number of firms that have revised their expectations for the first Fed rate cut, with a lot of them pushing it back. Goldman Sachs to December, Bank of America moving to mid-2027 from later this year. PIMCO raising the possibility, Dan Ivison, of possibly a rate hike being the next move because of this inflationary pressure. So Wall Street's starting to sniff out something different. At what point does the Fed have to catch up?
Dan Ivison with some interesting comments in the Financial Times we'll return to later this hour. Equity futures on the S&P 500 very, very close to all-time highs. Coming up this hour, Aaron Kennon of Clear Harbor Asset Management as the equity rally slows. Norman Ruule of CSIS as President Trump rejects Iran's latest peace proposal. And Ian Harnett of Absolute Strategy Research on the big tech meltdown. We begin this hour with stocks just about holding on to all-time highs. Aaron Kennon of Clear Harbor Asset Management writing, this has been an exceptional period for risk assets, and yet the composition of that return should give investors pause. Aaron joins us now for more. Aaron, good morning.
Good morning.
What a move in semis. 5% Friday, 11% last week. What are we, 60% off the lows from the end of March? Maybe more than that at this point. Are we in bubble territory now?
It's a good question. You know, semiconductors, like most cyclicals, tend to look really cheap when, they tend to be expensive when PE multiples are low, and they tend to to be quite cheap when P multiples are high. And, right now, if you take a look at some of the memory chip names like Micron and SK Hynix in Korea, they're trading at mid to high single-digit multiples. But that's because earnings have absolutely shot the moon. If you look at semiconductor exposure globally, you take a look at emerging markets, SK Hynix, Samsung, and Taiwan Semi. The top 3 holdings in emerging markets are semiconductor companies. 37% of the emerging market index is IT. You look at semiconductors in the United States, 8.5% return on the S&P 500, 7 names consisting of 70% of that return, all 7 focused on semiconductors. 2 are more diversified, Amazon and Alphabet, but still they're making semiconductors. The other 5 are pure semiconductor players. So this is a market globally, both home and abroad, very focused on that move.
At some point you end up with so-called overcapacity. We're just not there yet. And you mentioned the earnings. The earnings underpinned by fantastic spending coming from a number of places. What would upend that spending?
Well, I think at the end of the day, the return on investment question for the hyperscalers, for the Microsofts of the world, for the Alphabets of the world, may force, I wouldn't call a rapid adjustment in the CapEx expectations, but perhaps a modification of CapEx. If we're $750 billion this year, $850 billion next year, on semiconductor AI hyperscaler spend, and that adjustment moves from 850 to 8 or 850 to 750, that could alter investment perceptions of the slope of the spend that we would anticipate. I think that could bring some pause back into the market, into the enthusiasm of the semiconductor trade, and frankly could serve as a tailwind to the Microsofts, to the Alphabets, to the hyperscaler side of the equation. A focus on ROI would be a welcome tailwind, I think, to those areas of technology.
So how much of the rally is being underpinned by people who find it refreshing to talk about semiconductors rather than the war in Iran?
Well, it's a good question. I mean, geopolitics historically, Lisa, as we all know, have not really in the medium to long term driven asset prices too significantly. It's always been a sort of a temporary phenomenon. And I think the eyes continue to be on earnings. We had 17% earnings growth on an annualized basis this past quarter. And that's even maybe considered a bit low relative to some of the headline growth numbers that we've seen. But a lot of these big tech companies and hyperscalers have been buying private equity firms. And so, that 26% headline number is probably closer to 17. Growth has been really strong broadly as well. Median S&P 500 growing at 14%. So this is a broad earnings growth story.
I guess what I'm trying to get at is when does the real economy start to bleed into this semiconductor hopes and dreams that are driving this incredible rally? Is there some sort of trigger point where you get stagflationary worries baked into the market that starts to hamper this trade, that starts to hamper how much people will tolerate the increase in spending because prices are going up, not necessarily because they're building more capacity?
Yeah, I mean, it's a big question. It's a big political question that under sort of the undertone of that question speaks to some of the challenges around, data center growth, utility growth, the regulatory environment, not in my backyard, high energy prices, the inflationary picture, running above trend right now. We're going to see, CPI tomorrow, and how does that feed into the sort of broader market? But at the end of the day, you take a look at sort of the massive 36% of the S&P 500 is technology boom that we've been seeing across semis, and in a lot of the sectors of the economy that are much more sort of consumer focused are just smaller percentages of the overall index and have less of a contribution to overall performance.
We've got consumer issues, without a doubt, but right now that's a political problem. You're going to see that in the midterms potentially. That is not a market problem. Because
the averages don't really show it. And this is the reason why people are ignoring it. Even as things get K-shaped, and increasingly so, people say, well, that's too bad, and hopefully that doesn't lead to policies that are incredibly business negative. But until then, the music's playing, we're going to dance, and that's essentially what you're feeling.
Yeah, energy's, 3% of the S&P 500. Materials are less than 2% of the S&P 500. And so there you go. These are two big variables that are impacting consumers, but they're not impacting prices in the market.
And this Fed's not going to cut anytime soon. Yields up. Saw it on the graphic just there by 4 basis points this morning, 392. That's above the policy rate at the Federal Reserve. Unemployment close to 4%. You might have CPI close to 4% as well later this week. How much pressure is on the incoming Fed chair?
It's going to be interesting. Of course, you have the thought that maybe this energy price spike due to the Strait of Hormuz in Iran is going to subside in the weeks and months ahead. I mean, coupled with this idea that, not just an idea, we're seeing the data, employment remains relatively strong. Unemployment has trended up just a bit. If we were to see that soften a bit, I think on the margin, it gives the Fed an opportunity to cut again. But then you look at two-year Treasury yields at, 390 this morning, and the upper end of the Fed funds rate's at 375. So the market's not saying, oh, maybe the Fed's going to cut or hold. If anything, the market's starting to think, well, maybe the Fed is going to raise rates. Our view is the Fed's going to stay on hold for a while. They're going to stay on hold as long as they can. And when they see some easing light at the end of the tunnel, if that comes, they're going to be more poised to cut than to raise.
Lisa, if there's a threat to this rally, that's got to be the channel for it. The move from energy into rates and the prospect of a Fed needing to turn more hawkish.
And right now, Wall Street's turning more hawkish because they're looking at the fact that CPI is running, yes, above 2% for more than 5 years, but it's accelerating in the wrong direction. How long can they ignore that, say it's temporary, especially given the strength that you're seeing in the labor market?
Aaron, it's good to see you. Thanks for being here. Thank you, buddy. Aaron Kennon there of Clear Harbor Asset Management. Inflation, the main event throughout this week, CPI and PPI. Let's get you an update on stories worldwide this morning with your Bloomberg brief. Yahara has more. Hey, Yahara.
Good morning, John. The U.S. and Iran failing to agree on terms to end the war, with President Donald Trump calling Iran's response to the U.S. proposal, quote, totally unacceptable. The fragile month-long ceasefire, though, appearing to hold. Israeli Prime Minister Benjamin Netanyahu says he'd like to end U.S. financial support for Israel's military over the next decade. The U.S. currently provides Israel with $3.8 billion a year in military assistance under a 10-year agreement that was originally negotiated by the Obama administration. And repatriation flights for passengers aboard the cruise ship hit with the deadly hantavirus are underway. The World Health Organization recommends passengers return home and undergo monitoring for 42 days due to the virus incubation period. That's your Bloomberg brief. John?
Nope. Yahara, thank you. Just refusing to cover that story still. To seeing all those headlines over the weekend.
There are a lot of people who are saying that this is fear-mongering. So essentially, this is not another COVID, et cetera, et cetera. Then there are people saying, why'd they let them off the boat? Why not just send them to Antarctica?
Right.
That was the conversation at home.
We'll continue to bring you some updates throughout the next couple of hours. Up next on the program, the diplomatic effort facing a setback.
At the end of the day, we'll have free flow of traffic through the Straits of Hormuz, and we will have an end to the Iranian nuclear program. The end point we know. The route, we don't.
We're not close this morning. Norman Roule of CSIS joins us next. Live from New York City this morning. Good morning. Some important economic data in the week ahead, so let's get to those data points. CPI and PPI, retail sales as well, jobless claims. Look out for all of that. Then later on this week, too, the Trump-Xi summit over in China. Annmarie on the way to China. She's going to bring you coverage of that event right here on Bloomberg TV. The stakes are high going into that one. We're told that continuously. How much progress are we going to make?
This is the first meeting between President Trump and Xi Jinping in China going back to 2017. The last one was with President Trump. Question of who has the leverage, what the potential deliverables are, how much Iran is going to get in the way of otherwise negotiations that would have focused on chips, that would have focused on critical minerals, and creating this uneasy truce as these two economic superpowers try to reassert themselves on the world stage.
This is the delayed meeting.
Correct.
Delayed because of the war in the Middle East. And we thought by the time this takes place, this will be done and dusted. The flow of energy will be back all over again. And that's not where we are going into this at all.
One key question for a lot of strategists is whether President Trump is trying to take the temperature down with Iran ahead of this meeting, whether the goal is to get some sort of deliverable by the end of this week from Iran. What happens if he doesn't? Does that really raise the prospect once again of potential military action post-summit if that does occur?
It's a big story for us later this week. Here's the price action at the start of this week. Equity futures slightly negative, holding on to all-time highs on the S&P 500 and the Nasdaq. In the commodity market, Brent and WTI just inching higher. Wouldn't call this a surge, wouldn't really call this a jump. Up by 2% on Brent, up by 2% on WTI. But with that move, that grind higher in crude, look at this move in yields. Yields up again on a 2-year, this time by 4 basis points. 392 just getting closer and closer to to 4%.
Part of this is because you are starting to see the inflationary pressures come through avenues like food prices, which are rising pretty considerably, particularly when it comes to cooking oil. It also is coming through as you think about the fiscal response, the idea of eliminating the gas tax, for example, or in Europe, the idea of potentially funding some of these consumer-friendly initiatives. So it's a 1-2 punch here that leaves us with a bit more of an inflationary tilt.
These things are expensive. The 10-year this morning, close to 440. Under surveillance this morning, the diplomatic effort facing a setback.
Things are tough for the leaders of Iran right now, and I think they get growing motivation to make a deal. But we know where this is going to end. We don't know the route to there, but at the end of the day, we'll have free flow of traffic through the Straits of Hormuz, and we will have an end to the Iranian nuclear program. The end point we know, the route we don't.
So here's the latest this morning. President Trump rejecting Iran's latest proposal for peace, calling Tehran's response, quote, totally unacceptable. Bloomberg's Mika Salner joins us now for more. Mika, welcome to the program. What was unacceptable about the proposal?
Yes, the White House has been very adamant that they want nothing less than essentially a promise from the Iranian regime that they would, never try and get a nuclear weapon. Again, this is a claim that the Iranian government has denied, but that is what the administration has been really hung up on. The president has not elaborated exact details in terms of what he doesn't like. In particular about this deal, he has sent out a public post. I know this comes on the heels also with his summit with Chinese President Xi Jinping, so we're going to see this come up. We should get a lot more from the White House this week, too, and reaction there.
Mika, to that point, he also hasn't really articulated or communicated what the next steps would be, since this proposal was so-called unacceptable. Do we have any idea of what the next steps might be?
You know, I think that we will see more information come out, but the White House has been very, very tight-lipped in terms of what the actual plan is here. And this also comes as they're facing a lot of economic fallback. This is an election year. I know that the people very close to the president are very, very concerned about these rising gas prices that are not going to come down. We may not even see them de-escalate even after the Strait of Hormuz is reopened. So they're grappling with a lot here, and we're going to get some answers hopefully this week.
Mika, thank you. Mika Salner down in Washington, D.C. There's three options on the table: resume the hostilities, maintain the blockade, or walk away. And it feels like right now that many of these officials in this administration are comfortable with maintaining the blockade.
Yeah, and that's not really where people are in the GCC. And this is sort of some of the tensions you've got to watch, given the fact that there's an aspect of resume military actions, don't walk away, because don't leave this mess in our hands. So that leaves the third option. And I'm curious how realistic that is, given the troop buildup there and given some of the resources that the U.S. has directed to the region.
And let's get some insight now from Norman Roule of CSIS. Norm joins us now for more. Norma, well, welcome back to the programme. What was your reaction to the president's reaction, and how should we think about the ultimate path forward from here?
Good morning. We have entered a structurally unstable portion of the negotiations. In essence, each side is asking the other to give up their leverage over the other. The United States is asking for the Iranians to commit to nuclear concessions and to opening the Strait of Hormuz. The Iranians are asking for significant sanctions relief and financial concessions at the signing of the talks before they do anything, and then to put off nuclear talks for the future, which obviously would be unacceptable to the United States. The options for the United States at this point are, as you've stated, limited. It is likely, therefore, that the United States, especially going into the meeting with China, would continue the blockade, but ensure that we take no foolishness from the Chinese, from the Iranians, and they don't test the blockade, and to ensure that we move forward with the current procedures.
Norm, what took so long? Why did it take such a long time for the Iranians to get back with some sort of response, especially considering that it was, as President Trump said, totally a non-starter?
I think there are a couple of things going on here. First, that is typical for Iran. The Iranians do not traditionally respond quickly. Secondly, remember, for the Iranians, they're negotiating over the fate of the Islamic Republic. They're looking at the fine print of these issues very carefully. They get this wrong, the Islamic Republic will fail. They need this sanctions relief to sustain themselves through economic hard times with against a hostile population. The third point is that they may not necessarily see themselves as losing in terms of the clock Washington itself faces with the rising oil prices and the economic and political pressures faced in the West. So that is also underway. In terms of an internal debate within Tehran, although there is certainly a tactical debate in terms of concessions, Qalibaf and Arakchi are certainly not trying to shift the fate of the Islamic Republic. They could also wish to sustain the regime.
Norm, do you think that the bar is lowered to resume some active fighting after the summit with Xi Jinping, given the fact that there seemed to be an effort to de-escalate heading into that?
I think it's more accurate to say the bar is starting to be lowered. The president has all the assets in place to open the Strait of Hormuz and to take action against Iran's theater ballistic missiles and drones. The president has a strong history of not sitting back if he believes time is being wasted by when the Iranians don't take negotiations seriously. And the Iranians are showing a lot of behavior that is not serious. The tweets that they've put out have been insulting. They are not sending delegates to Pakistan. They are late in their responses, as you put it, and the responses are showing no sign of concessions. So all of that does augur for something closer to a resumption of hostilities.
Norm, what are the concessions that you would look for Iran to make to avoid some of that?
Well, I would look for some sort of response in the coming week in which they would indicate something closer on enrichment concessions, where they would move a little closer to giving up a portion of their enrichment capacity. Right now, what the Iranians are saying is they want 5-year curtailment of their enrichment. We're looking for something at 20 years. Now, moving something closer in the number of years that we're seeking. We're saying that we would like them to remove their enriched uranium and give it to the United States. They're saying they will give it to a third party, but they'd like it back if the deal falls through. Something closer to the United States position in that regard would be important. We can't have a situation where the Iranians build an enrichment capacity and then say, well, we'll build it and then send out what we produce. But at any moment, we could change that and just start building a bomb if we decided to do so. We can't have that situation develop either. So some sort of structural concession that would give the U.S. confidence that they're not going to have a nuclear program would be important.
Norm, extend and pretend. They're very good at doing that. They have been for a long time. Do you think they are stringing this administration along and looking to extend and pretend?
To an extent, but remember, Iran does have severe economic problems. The administration is correct in this regard. And of course, the Iranians are hiding this fact from the world and their own people. They control the narrative in this regard. They're shutting off the internet. They're shutting off. They're hiding their own situation. And Foreign Minister Arakchi, whose job is in essence to lie about this to the world and to put on a brave face, is trying to not talk about the severe inflation, the severe unemployment, the severe economic problems they're facing from the blockade. And so there is an erosion of their economic situation, which can only go on so long. And when this blockade ends, they still face an extremely hostile population, which is likely to erupt into nationwide unrest, such as we've seen in the past at some point.
Norman, it's good to see you, sir. Thanks for making time for us this morning. Norman Roule there of CSIS. The headline there, the obvious one, a response to Lisa's question. The bar for a resumption of hostilities is being lowered.
Well, and that's because of exactly what you're talking about, which is this pushing the can down the road and not giving a real answer. Why did it take a week? Were they ghosting them? Were they just trying to make them more I mean, why did it take so long to come back with a proposal that we've heard before from this regime?
There is this uncomfortable, uneasy quiet right now. The president has called it totally unappealing to him, and yet at the same time has not articulated what he's going to do next. Up next, we'll catch up with Lizzie Burden as the British Prime Minister holds on to his political life. Equity futures holding on to all-time highs on the S&P 500. Similar story on the Nasdaq following a 6-week run, the longest since October 2024. We could add to those gains even with this move in crude, pushing higher. WTI and Brent. Last week, Brent down by about 6-7%. Brent this morning up by 2 to 103. WTI just short of 100 at 97. There were plenty of reasons for crude to go higher this morning following the president's rejection of the Iranian proposal. Crude, relative to some of the moves we've seen in the last 2 months, that is not a big move.
You know, part of this is because people don't really understand how to interpret these headlines. Does it mean we're closer to a resumption of some sort of hot war? Also because people are beginning to appreciate the degree to which there has been a buffer of U.S. oil exports as well as the reserves that people are unleashing. These are the reasons why you haven't seen prices move higher. Question a lot of people are asking is how long can we continue dripping out of this kind of regime until we have oil prices that go much higher? Nonetheless, it seems like we haven't necessarily hit that point now.
In Iran, the focus is on tank tops. How close are we to breaching storage capacity? Everywhere else is tank bottoms. This from Jeff Curry of Carlisle. We have a deficit today, meaning that demand is above supply and we're drawing inventories. It's not a shortage yet. Punchline. It becomes a shortage when you hit tank bottoms. Who gets to where first seems to be the high-stakes blinking contest in the commodity market.
Who has to cancel flights? Who has to cancel business? We've already seen that in certain regions. A lot of people are watching, though, December, January dated Brent, and you're looking at prices that are creeping higher for longer. So even though you aren't necessarily seeing the huge knee-jerk moves in the near term, you are seeing long-term expectations for oil prices to remain high. And that, I think, is going to affect some of the inflation expectations in markets.
This is how most of my mornings start at the moment. For Lisa and me, I know. We start with crude, and then we bring up the screen on the Bloomberg and look at the bond market. What's happening with fixed income this morning? Yields are up by 3 to 4 basis points. Two's at 392. And then you, like me, over the weekend, looking at Dan Iverson and the FT, talking at the prospect, and I stress prospect, not base case, but the prospect of rate hikes at the Federal Reserve.
Yeah, saying, look, the U.S. is further away from that, from raising rates, but you're going to see more tightening as it looks today in Europe, in the UK, and maybe even Japan. And I wouldn't take it completely off the table for the United States either. Tomorrow, CPI, Wednesday, PPI. We start getting an increasing inflection higher with the sentiment that you're seeing in consumers falling off a cliff. At what point does the Fed have to step in, especially because inflation expectations are starting to creep higher, too, in the break-even rates?
Kevin Walsh is stepping in. Good luck handling that situation at the Federal Reserve at your first meeting. Unreal. Things are building and building to some real drama at the FOMC in the next month or so. As we count you down to the opening bell, we are about 3 hours away. Let's get you some single names of morning movers. Yahara has more. Hey, Yahara.
Hi, John. We start with shares of Moderna. They are up 7% in the pre-market, really for 2 reasons. First, these reports that President Donald Trump is getting ready to fire his FDA commissioner, whose tougher scrutiny on COVID vaccines has been a major drag for this company. And second, that the company said on Friday that it's already researching hantavirus vaccines. Turning to shares of Lumentum, also surging in the pre-market, up 4.6% on the announcement that the company will join the NASDAQ 100. The company has already been on a tear this year, up some 130% due to demand for its networking equipment due to AI. And we could see some more buying now from passive funds as well as ETFs. And the chips rally is carrying into this week. We saw it overnight in Asia, and it's happening here in the U.S. as well. Intel up 6%, adding to Friday's massive gains after that Wall Street Journal report that it has struck a preliminary deal with Apple to manufacture some chips for its devices. This would mark a major win for the Intel foundry, which has struggled for years to attract large outside customers. John?
Yahara, thank you. Thank you very much. Let's just stick on that just for a beat. Typically, I've never really enjoyed benchmarking to .com because you're benchmarking to the extreme. And often people use it as a justification to come on the program and say it's not expensive, it's not .com, etc., etc., etc. But now, when you benchmark to the extreme, it's interesting this time because we actually are close to some of those levels, just in terms of the way this stock market has moved. To see these moves like Intel, again this morning on very little news, just continue to mount higher by another 6%.
Yeah, and another parallel to that moment, and it's something that Dan Greenhouse pointed out over at Solace. was that at that time, it wasn't like these companies were terrible companies that weren't making profits. If you take a look at Cisco, it was actually generating a really big return on capital. But then the whole nature of the internet changed. So yes, you can talk about valuations that are similar to the dot-com bubble, but you can also point to some of the hopes and dreams and how it was coming through in the earnings growth. So that's the reason why people are getting a little concerned that maybe we're reaching a top.
The spending that's funding it, a lot of it has come from cash, from the big hyperscalers that's been driving these names. Now it's starting to shift to debt. Maybe the runway is longer. Maybe that's the argument we might hear in the weeks to come.
Yeah, we're hearing that as Amazon taps the Swiss market for the first time ever. You're seeing Google go over to Japan for the first time ever. You're seeing all of these companies see where they can raise pennies in any particular corner because they want to diversify their exposure. If their runway has gotten longer, can they get to the sort of nirvana? I just want to understand what the ultimate goal is. Is it for all of us to have our own AI assistant? Is it for us all to have a little dog that does all our tasks for us because it can morph into a human? I mean, honestly, I don't understand exactly what our aim is other than AGI, which is going to be some sort of, godlike automated creature.
Dogs morphing into humans on everyone's mind as they're buying Intel this morning, obviously. Intel up by 6% so far in the pre-market. On our radar this morning, President Donald Trump rejecting Iran's latest peace deal as, quote, totally unacceptable. The Wall Street Journal reporting Tehran wants to transfer some enriched uranium to a third country, but it won't dismantle its nuclear facilities. Elsewhere, the president planning to press China's Xi Jinping over the war in Iran when they meet in Beijing later this week. Sources telling us here at Bloomberg the two will discuss the money China provides to Tehran and potential weapons exports. And finally, the Energy Secretary Chris Wright saying the Trump administration is open to suspending the federal gas tax.
All measures that can be taken to lower the price at the pump and lower the prices for Americans, this administration is in support of. We are constantly looking for different ideas. We've taken a number of actions.
The U.S. national average for a gallon of gas is $4.52, including the 18-cent tax. We've seen a major move in gas over the last few months.
Yeah, how much does 18 cents actually accomplish when it comes to lowering the price for people who go to fill up their tank and find out that it costs $70, $80, $100 when it normally would have cost $50? It shows how desperate some governments are becoming to offset the pain that consumers are feeling because this is increasingly a political liability. Question is, what's that going to do other than just sort of increase the deficit? And suddenly people over the weekend in my family were getting very concerned about the deficit.
Stop the press.
Okay.
Who?
My father opened up Mother's Day dinner last night. Why is no one caring about the deficit?
That's how your dad started the meal.
We're definitely getting back to that place. So, there is this feeling that maybe there's going to have to be some measures that's going to cause some sort of significant inflation by some people who might be investing in solid assets. But I'm just curious about going forward, whether that's going to become an increasing concern as some of these politicians look to stave some of the pain. I'm going to keep talking so you can't respond.
Did you walk him off the ledge is what I really want to know.
I said people are very concerned about it. I talk about it regularly.
Right.
There is a feeling that there needs to be some degree of inflation or the dollar coming down. There's some feeling that AI can maybe productivity our way out of this. But I couldn't totally talk him off the ledge because there is some feeling that the deficit's going to be a problem at some time, and he started railing about Social Security, and then we changed the topic.
There is cause for concern. Yields are up again this morning by 3 basis points on a 2-year, 3.92 on the 10-year. For Daddy Bramo, 4.40 right now, up by about 3 basis points. Elsewhere, the British Prime Minister Keir Starmer holding on to his political life, delivering a speech earlier on this morning. Take a listen.
The election results last week were tough, very tough, and I take responsibility. But it's not just about taking responsibility for the results. It's about taking responsibility to explain how, as a political and electoral force, we will be better and do better in the months and years ahead.
Bloomberg's Lizzie Burden, tracking the speech from Downing Street for us, joins us this morning. Lizzie, welcome to the programme. Heavy on vibes, light on policy. Is that enough from the British Prime Minister?
We're going to have to find out throughout the day, John, as the reaction comes in from MPs. Already 2, at least, since the speech have called for the Prime Minister to go. This was a huge moment for Keir Starmer, and we're waiting to see whether he managed to live up to it. He promised to prove the doubters wrong. He had messages on multiple fronts. First of all, for the voters, accepting, as you heard, their personal responsibility for this bruising defeat at the local elections last week. Labour losing 3 out of every 5 seats that they were defending. He also had a message for his party, accepting that emotional dimension to the defeat and promising his party that he actually can translate policy into an emotional message for the public. And that's what he's going to need to do if he is to defeat reform at the general election when it comes. He also, it seems to us, had a message for markets, which is that he's staying in post. We saw gilts rallying on Friday in response to that message. Today, not so much. We've seen bond yields higher around the world, mainly because of higher oil prices, because of the lack of a solution to the US-Iran war. But the moves are pronounced here in Britain, and they haven't really come down as a result of Keir Starmer's speech. In fact, we've seen the pound drifting lower since Starmer's speech. So as his rivals continue to swirl, the likes of Wes Streeting, Angela Rayner, it seems like Starmer remains on the ropes, John.
Lizzie, this is why it is a bond market event. It's about the risk of what comes next, not about Starmer. It's not about confidence in him and his policies. I'm not sure there are many people in the economics community that still has that confidence left. It's the risk of what comes next, Lizzie. And what do you believe would come next if he did indeed decide to choose to write and deliver a very different speech?
Well, the risk is that you get someone who is more fiscally lax than Keir Starmer and his Chancellor Rachel Reeves. You already have the Mayor of Greater Manchester, Andy Burnham, very popular, but he doesn't have a seat in Parliament, so at the moment he isn't a credible threat. You also had Catherine West, who I'm sure viewers in the US perhaps haven't heard of, a pretty unknown backbencher, former junior minister, over the weekend threatening that she would launch a leadership challenge if Starmer didn't press that reset button hard enough in this speech. We'll have to see what she has to say about this. But she has already described herself as a stalking horse. It's more to open the door to other challengers so that more serious challenges can come to the fore. They would be in the form of Wes Streeting, as I say, Health Secretary, and Angela Rayner, former Deputy Prime Minister. But it could be that they are prompted to challenge Starmer more sooner because of how well Burnham is polling and because of the fact that he doesn't have a seat in Parliament for now.
Lizzie Burnham with the latest. Lizzie, thank you. Out of number 10 Downing Street this morning, following that speech from Sir Keir Starmer, the British Prime Minister, holding on to his political life. And Bramo, this was billed as a massive speech in the UK. He was going to come out with all kinds of announcements. There was nothing in there on the policy front, really. Nothing at all. Heavy on vibes, light on policy. There's going to be pressure building in the weeks and months to come, without a doubt.
A lovely story about his sister, about nursing challenges, about what it means to be an average working class person. The vibes were not enough, and that's what the market is essentially saying, and there needs to be some change. She also talked about the Iran war and really laid into how it was important for them not to get involved in a war that was not theirs of choosing, which gives you a sense of the popularity or the lack thereof in Europe and how this is increasingly becoming a political issue. The way that Stephen Major talks about it is political histrionics, and that, added to sticky inflation and structural shifts, is the perfect storm for the UK pound and, frankly, for the rates market. And you're seeing that this morning.
Bond yields close to multi-decade highs in the UK gilt market. Let's get you an update on news elsewhere this morning with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. Indian Prime Minister Narendra Modi is urging citizens to curb fuel use as rising oil prices strain the economy and push the rupee to record lows. Modi suggests working from home and online meetings to conserve energy and is urging citizens to avoid unnecessary overseas travel. U.S. Treasury Scott Bessent is heading to Asia for meetings in Japan and South Korea. Bessent will meet with Japan's Prime Minister and China's Vice Premier before joining President Trump in Beijing for his summit with Chinese President Xi Jinping on Thursday. And Alphabet is on the verge of overtaking NVIDIA as the world's most valuable company with just $400 billion in market cap between them. Alphabet is taking the lead in nearly every aspect of AI technology, the company recording its best month in April since 2004. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Thanks for the update. Up next on the programme, big techs, big melt up.
What is the dominant theme that is driving all things in these markets? What we're seeing in financial markets, both macro and micro, it's just much more about this AI theme.
Up next, we'll catch up with Ian Harnett of Absolute Strategy Research from New York City. You're watching Bloomberg TV. Equity futures pulling back by just 0.1% on the S&P 500. Right now, the Nasdaq a similar move, and a Russell too. In the commodity market, Brent and WTI pushing slightly higher this morning by 2 to 3%. Not a major move. Brent crude 104. In this kind of wait-and-see mode now. The president rejecting the proposal coming back from the Iranians, but not articulating or communicating what he'll do next. So wait and see for the next few days, potentially.
Yeah, the Norman Rule did say that the bar is getting lowered for perhaps restarting some sort of re-engagement militarily. You're seeing this with assets increasingly moved to the region. What could the response in markets be to that type of action? Should it be taken, particularly if it comes after the summit with Xi Jinping?
The response of the last few weeks is just to buy equities and to keep buying equities. Under surveillance this morning, big techs, big melt up.
What is the dominant theme that is driving all things in these markets? Whether you're a macro player or a micro player, the story isn't really so much traditional macroeconomics. Macroeconomics have been taken over by the AI theme. What we're seeing in financial markets, both macro and micro, it's just much more about this AI theme.
So here's the latest this morning. Tech leading a global equity rally on resurging AI optimism and strong earnings. Ian Harnett of Absolute Strategy writing, at a sector level, we continue to see US and global tech and basic upgrades dominating. Ian joins us now for more. Ian, good morning. Good to see you.
Good morning. Great to see you.
Last time we caught up, you were talking about a tech capex-driven bubble in the equity market. You see more of the same?
Oh, absolutely. You know, just look at this market. It's really strong. It's driven by earnings momentum, and that earnings momentum is driven by this technological change that's coming through. You know, it's really, really strong. You know, I think we've seen what the US tech hardware stocks up 25% in a month. You know, some of the, you know, the Taiwanese stock market, the Korean stock market, absolutely on fire. Very much this is a tech-driven market. It's an earnings momentum-driven market, Jonathan.
The earnings component of it is the most important.
Yeah.
It's underpinned by a lot of spending from a lot of very rich, wealthy companies who are doing that out of cash. And now that's starting to change. It's starting to become debt-funded. Does that extend the runway or compromise the story?
It's both, isn't it? Because it increases that eventual fragility. But that fragility only gets exposed once you get some kind of squeeze on that economic activity, rates going up, you know, those oil prices remain high for longer. You know, I was looking at your chart just now. We've only really seen gas prices up significantly, 50%, very significantly, but only for a month and a half. Typically, it takes about 6 months for these things to really drag down on economic growth. But you're increasing that fragility by going to the debt market, with people like Alphabet not really having done so before so much. So, you know, this is a bit of a change here.
When you lean into the bubble concept, but then you also point to the fact that earnings are holding in, it feels like something of a contradiction. Some people are saying the reason why it's not a bubble is because earnings are holding in. Why do you see it as potentially being a bubble, even with earnings doing what they are?
So I think if you look at what historically bubbles have, they have size and they have pace. We've definitely got that. You know, if we have people buying each other's companies with that elevated share price, buying each other's goods. Even better, I lend you money to buy my goods. And then that drives down, you know, the cost of capital as, you know, these stocks become Giffen goods. They get more attractive as the price goes up. And that drives down the cost of capital, and capex goes through the roof. These are all symptoms, Lisa, of the end phase of a bubble. But it doesn't mean you're at the end of the bubble. As I say, you know, nominal earnings respond to nominal growth. And actually, that's where, you know, higher oil prices, higher price levels generally are quite positive for corporate profits initially. But then, you know, if you see that cash flow coming down, coming under pressure more generally, that's when you start to see the stress emerging in these bubbles. And, you know, clearly that's not going to happen for a while yet.
Well, so investors have largely been saying that the tech sector is immune to what's going on economically. You're making the argument that if we do get a stagflationary type of environment with higher inflation and slower growth, that will cause potentially the end of this bubble. Can you walk through how that looks?
Yeah, so I think the thing that you have to recognise is that stagflation always kills valuation. You know, the combination of higher inflation and lower growth is a killer for PE multiples. And so, you know, at the same time, you have to recognise that it's not actually the underlying quality of the companies themselves. You know, the winners that we had in 2000 are actually the winners in this digital world today. Probably the winners in the AI world today are going to be the winners in the AI world of the future. But it didn't stop some of those big companies, Amazon, Oracle, you know, losing between 65% and 95% of their value in the 2000 bubble burst. And the key to it is that the people that are buying their services, the people buying their goods, they run out of money, and that's the thing that compromises the whole structural story. So that's the thing that we're watching for. The signs not of stress in the credit market for tech stocks, but broader credit stress, because that's going to be telling you about real cash flow stress across the economy as a whole. And that's what stagflation really brings.
You can make a strong argument for deflation right now. Can you make a convincing argument for the stag?
No. And I think that that's the reason why we're still, we're cautious, but we're not bearish. And I think that's the thing that's got to really change here, Jonathan. And our argument has always been you have to see these elevated commodity prices remaining higher for longer. And historically, if you go back over 100 years, each of these big stagflation shocks that we've had has seen interest rates go up. And I heard you talking about interest rate rises this morning. So what's in the futures market? 25 basis points. That's nothing. Normally, if you have a stagflation response, a policy response that's going to deliver stagflation, it's 250 basis points, it's 400 basis points. That's the kind of policy move you'd need to see coming out of the Fed.
If you look at where we are now, the data's OK, the earnings are great, big tech's still spending and the Fed's not hiking. It's hard to be anything other than bullish, isn't it?
Well, you have to be somewhat cautious because it could tip the other way. As you say, if we move back into a kinetic world, I'm a bit more pessimistic, perhaps. I think if we saw oil prices up to 120, after a few attacks on Iran starting again, then you'd actually start to see the bond market, maybe that 30-year above 5%, that starts to weaken people's, positive outlook. But underlying that, you are absolutely right, Jonathan. The point we've been making for a year and a half, double-digit earnings growth with interest rate expectations still, a year out, down rather than up in a meaningful way. Hard to be too bearish, isn't it?
It's difficult to fight that, Ian. It's good to see you in person.
Great to see you.
Thanks for being here in New York. Enjoy your time here. Ian Harnett there of Absolute Strategy Research. Just working through some of the moves we've seen, and we've seen some major moves. Last week alone, 5% on Friday in semis, another 11% on the index through the week. A major move off the bottom from the end of March.
I'm still thinking about what Ian said, that it would take 250 basis points to really have that stagflation type of response. Is there the political will for 250 basis points of hiking? And the fact that people do not believe that there is the will is the reason why people are saying probably it's better to invest in stocks that can go to the moon with an overly easy financial policy. But then there are people out there, some, who are worried about the deficit. And this is sort of the cycle that people are looking at. On one hand, this is the previous response. But this is not a response that necessarily policymakers are willing to take this time around because of the political pressure.
Give me some space here. Let's round down unemployment and let's round up inflation and what we expect this week. Basically in the fours, unemployment and CPI, and the Fed's got an easing bias. That's astonishing. That really is astonishing.
And arguably, the next Fed chair will maintain that, even in the face of quite a bit of opposition from a number of Fed presidents, regional Fed presidents, and even Fed governors who are saying, wait a second, guys, this is not a good equation. Maybe it's not transitory. Maybe we messed up when we talked about the T word back in 2021. I don't know.
Equity futures right now holding on to all-time highs, pulling back by just 0.1%. Up next, we'll catch up with Sarah Hunt of Alpine, Saxon Woods, Rachel Ziemba of the Centre for a New American Security, Ruqaiya Ibrahim of BCA Research, and Matt Hornbach of Morgan Stanley. The second hour of Bloomberg Surveillance just around the corner.
We've seen the data just continue to be resilient.
This all points to an economy that's doing quite well.
That's the take from the payroll report. Not a huge change in terms of the information.
We really do need to keep that dual mandate in focus.
The bar to cut is anyway a little bit higher.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your price action of scores look like this. All-time highs on Friday, another week of gains. We've had 6 consecutive weeks of gains on the S&P 500 this morning, down by not even 0.1%. In the face of this, crude higher by more than 2%, Brent at 104, WTI just short of 98, and bond yields higher too. Across the curve, 10s up by 3 basis points, 440, 2s at 392. Going into this, a week of inflation data, CPI, PPI, just around the corner.
So Tuesday we get CPI, on Wednesday we get PPI, and then on Thursday we get April retail sales, all accompanied with, guess what, debt sales. We have $42 billion of 10-year notes being sold tomorrow. We've got 3-year notes being sold today. This is the confluence of issues that the market is trying to suss out. We have inflation that's above target, a Fed that could be moving away from an easing bias, and a huge bill to finance. These three issues coming together are leaving the bond market with a little bit of the yips, and that's going to be the story this week as we get some of this data.
Get more of that. That's a headwind to this market. Max Kettner, HSBC, super bullish equities. Lots of reasons for it. Earnings a big part of it. But ask him about the bond market and he'll tell you the danger zone. The danger zone around 450 on 10s. That's where things start to get a little bit jittery in the equity market.
And what Ian Harnett was talking about shows the nuance of this. On one hand, you've got a valuation problem, and you could say, well, earnings are growing so much faster than the valuation, so you can offset that to a certain degree. But then you start talking about the constraint in the rest of the economy, what this does to smaller companies that have been the engine of growth. You start to see the cash flow dry up there. Who's going to finance the AI boom? Who's going to need the boom to finance their business? Because ultimately, business will not be booming. You asked it great. We've got the inflation part of stagflation. We do not have the stag. You start to see some of the stag on the heels of higher rates, then you have a different equation.
You don't see much of that right now, do you, Ed Yardeni? Ed Yardeni over at Ed Yardeni Research. We're raising our year-end target from 7,700 to 8,250. Pretty blunt with it. We've never seen consensus earnings expectations rise so quickly for the current and coming years, and as they have in recent months.
Yeah, and you talked about Lori Calvasina also raising her target to 7,900. That's a 10% upside from where we are right now on the same thing. Earnings have been growing. At the same time, earnings are growing because it could arguably be, as Ian kind of pointed out, not a big Ponzi scheme, but, they're growing. I lend you money to grow more, and then you grow more. And at a certain point, if real people cannot keep spending, the cycle comes to a grinding halt. And that is what people are concerned about. We don't see it now. How quickly could it change? We have seen some indications from credit card companies, as well as a couple of retailers, that the lower end consumer is starting to pull back. Is it migrating higher? And is it going to materially shift the averages, which have been otherwise solid?
Equity futures this morning down by not even 0.1%. Coming up this hour, we'll catch up with Sarah Hunt of Alpine, Saxon Woods, with stocks holding on to record highs. Rachel Ziemba of the Center for a New American Security on President Trump's trip to China. Plus, Ruqayya Ibrahim of BCA Research with crude prices rising this morning. We begin this hour with stocks holding on to gains as the diplomatic effort in the Middle East stumbles. Sarah Hunt of Alpine, Saxon Woods writing, there are still some things that give one pause. A lack of throughput in an important choke point, higher energy prices and gas on the rise, fueling concerns that other price levels may follow. Sarah joins us now for more. Sarah, good morning.
Good morning.
You heard the previous conversation. Earnings have been great. The Fed's got an easing bias. The data's OK. Lots of people are bullish, particularly on the AI ecosystem. What's the bear case now? What is the bear case?
I think the biggest concern is that you have this, we've had a buffer on energy prices, and there's arguments about when that stops out, when do we hit the bottom of the tanker, when does this really become an issue? So far, it's been, I hate to use the word manageable because it's a terrible conflict, but so far from a market perspective and an economic perspective, it's been manageable. If that starts to really become an issue, I saw a couple of things over the weekend about airlines saying we have access to jet fuel because there was concerns about flights being canceled, and yet some companies are canceling flights anyway. Those are the things that could really change perception and change sentiment very quickly if all of a sudden you get a big move in energy prices because you've hit that wall. And I don't know whether or not that's going to happen, but I think that's one of the biggest concerns. And I think just generally speaking, the unemployment picture, private credit hasn't gone away. I can talk about the things that are worrying.
Well, let's start with energy then. You brought up energy. We've got a decent idea, not a fantastic idea, but a decent idea of the inventory drawdown. How long's the runway?
I think this is the biggest question, because if you'd asked me that question, and we did talk about this question 2.5 months ago, I would have said that by now we would be in more serious trouble than we are. And I think that this is a question of whether or not it is a adjustment that people are making, whether there's a substitute effect. You're getting oil from other places that you didn't get it before. You've got some pipelines moving more than they were. But that's a big amount of stuff that's not getting through. And it's not just oil, it's fertilizer. It's things that have knock-on effects later about pricing that we're not, I think, taking into account. And I think that's some of the concern. concern that people have about where earnings go. Because yes, the technology earnings growth are growing very hard, but if you look at some of the individual stocks on the non-technology level, you've seen some reaction to the lack of spending.
You talk about sentiment rolling over. Well, sentiment's rolling over, at least if you believe the University of Michigan Sentiment Survey, which hit another record low on Friday when it came out. Everyone seems to be saying, next, flip it over, because it hasn't worked for a number of years now. But what is the first signal to you that there is some market change in consumer behavior?
I think the problem with the Michigan Sentiment Survey is more that people have been saying one thing and doing another. So the spending has been coming through. Retail sales have been strong. You've seen reasonably good hard economic statistics versus the soft data stuff. So it would have to be a slowdown to get to the stag part, right? You'd have to actually see the economy slow down more meaningfully. I think there's some issues with the last labor report in terms of full-time jobs versus part-time jobs, but the labor market still looks pretty robust. It's not so terrible yet that you see problems coming on in that part of the economic data. But you start to see that change and you start to see other sectors of the economy have trouble with earnings. Then I think you get a little bit of a different picture. And I don't think we're quite there yet.
Is it bullish when you hear Chris Wright, the Energy Secretary, say things like they're thinking of having a gas tax holiday, of dropping the 18 cents off the $4.50 or higher on a gallon of gas to potentially offset some of the pain for consumers?
No, I wouldn't call that bullish. I'd call that one more trick in the book of what we can do because prices aren't coming down fast enough. I don't know that that's sustainable. I certainly know the government can use all the revenues it can get right now. So I'm not sure what the trade-off there is and how long that could possibly last. I think the real question is you have to start seeing traffic come through. And once that happens, even if prices stay elevated for a while, there will be a relief just in that alone. I think that prior to the answer that this was not acceptable, markets were starting to rally on the back of that over the weekend anyway. And I think that just, that has been continuing. But I really think you have to get that open. And we haven't seen it yet.
The clip with the Energy Secretary a little bit later in the hour. I think it's notable that he didn't push back because we asked him directly about banning exports and he did push back, very aggressively so, was blunt about it. But with this, he didn't. And I just wonder if that's something that is on the table right now at the administration, something they're willing to explore.
He talked about how everything's on the table. And again, those everything, does it mean that potentially you have a higher deficit? Potentially you have more robust spending. It highlights the policy reluctance to really allow pain to take hold in consumers heading into midterm elections, which arguably is bullish for markets because they're going to pull out everything that they possibly can to keep this market continuing to rally.
Nobody wants the demand destruction. Nobody at all. And to Lisa's point, takes me back to fixed income again. They all want to support this. They all want to keep this economy going for obvious reasons, but that comes with a cost. Yields are drifting higher across the yield curve, not just in Europe, but in the US as well. When does that become a problem to this equity market rally, these bond market moves?
I'm hesitant to pick out a level, but I think that just to your point, that drift higher, I mean, this ties back into some of the other areas that are not so strong, which is some of the private credit areas where people are still taking marks down, which is some of the concern. It's hard to refinance if rates are going higher. On the housing front, it's hard for mortgages. It's hard to see a lot of housing activity as rates start to creep higher. So all of those things together, I think, take a toll. And I think that that's one of those, again, sentiment can shift really fast. We've talked about the narrative whiplash that we've been going on for this year. I mean, just look at the chart of some of these. I mean, just look at the NASDAQ chart and you think to yourself, wow, that is not just a small sentiment shift. That is an absolute, oh my God, we better buy it now or something bad's going to happen. So I think that there's a lot of ways that things can shift. And right now, it's more of a wait and see. But I think it's going to be, CPI is going to be important tomorrow. Because if it's high, it's a problem.
A bit of panic buying, just kind of clicking in just a little bit. The people that missed this rally starting to panic a bit.
I think it's hard not to look at that chart and assume that there's no panic buying. There has to be some, though, right? Because you wouldn't be chasing something that's going vertical the way that is unless you felt like, oh my goodness, if I don't get in now, or I missed my window, or I didn't before. I think there's a lot of that. I think that's probably less on individuals and more on institutions.
We've all heard of the stories regarding career risk around .com, being too early, not buying into this. How much of that is doing the rounds right now? Can you afford to sit this out?
I think it's very difficult. I mean, I think that, this is where having a balance and being really careful about where you're positioned because you want to make sure that you've got companies that are truly cash flowing and truly growing because there's a lot of wheat that's being up with the chaff here. And there's a lot going on. So it's important stock selection.
How much is this also that these companies are becoming too big to fail? That if these companies were to really run into a problem, it would undermine the entire prospect for growth and productivity and the sense of sort of this melt up in the economy and economic growth. How much politically is this something that has to continue because these are too big to fail?
Well, what's interesting is I think that I absolutely agree that if this wasn't happening right now, if the AI boom wasn't happening, we would have a much bigger problem. But it is feeding on itself in a way that's it's important for it to keep going, but it's hard to see of the big companies which one is going to have a problem. The problem's going to come when you see somebody going, you know what, this growth isn't really helping margins, or you know what, we're going to back it down on CapEx a little bit more because of this and that. I think the problem is right now the momentum is in that direction. When that momentum pulls back a little, that's when people are going to question things. And if you then still don't have the Strait of Hormuz open and you don't see oil moving, it's going to be very hard for markets to be able to digest that.
Sarah, it's good to see you. Thank you. Sarah Hunt there of Alpine Saxon Woods. I'm always thinking about the year-end conversation, the evals, the conversation with your client or your employer. What's the biggest risk right now? We go up another 10, 15, 20% and you weren't in it? Or we go down another 10, 15, 20% and you were in it? What's the biggest risk to you right now into year-end?
Arguably the 10 to 15% higher. Because right now people are used to riding that boom, and ultimately any one of their friends are going to have already ridden that if it is up. I do wonder, though, what the inflation backdrop is going to be. That if you are not in it and inflation is a lot hotter, then you're going to have actually missed out on inflation-adjusted returns that much more. I mean, these are some of the conversations that people are having. It's damned if you do, damned if you don't.
Futures right now in the S&P holding on to all-time highs. Let's give you an update on stories elsewhere this morning. With your Bloomberg brief, Yahara has more. Hey, Yahara.
Hi, John. The U.S. and Iran failing to agree on terms to end the war. President Donald Trump calling Iran's response to the U.S. proposal, quote, totally unacceptable. The fragile month-long ceasefire, though, appearing to hold. Apollo is holding talks to sell Midcap Financial Investment Corp, its publicly listed business development company. The Wall Street Journal reporting Apollo values the fund and its investments at roughly $3 billion. And Intel shares are rising 5.75% after reportedly reaching a preliminary agreement with Apple to manufacture some of the chips in its devices. The Wall Street Journal reporting the two companies have been in talks for over a year. It's unclear which products the chips would be used in. That's your Bloomberg Brief. John.
Yahara, thank you. Thank you for the update. More from Yahara later this hour. Up next on the program, the cost of conflict.
We're draining our resources in a war in Iran. It's cost us billions of dollars, and it's increased our food prices. And China basically is just watching from the sideline. They're not sinking that money into the Middle East. They're sinking that money into building their economy.
Up next, we'll catch up with Rachel Ziemba of the Center for a New American Security from New York City this morning. Good morning. Tomorrow, the data point of the week. Tomorrow, 8:30 Eastern Time, CPI. Then another read on inflation, PPI. Then later in the week, how much are consumers spending with the cash crunch at the gas pump, retail sales, coming up on Thursday.
This is going to be one of the key weeks, especially after we put fears about the job market to rest last week when we had the jobs print that came in above expectations and otherwise looked to be somewhat solid. Now we find out if that continues through the month of April, whether this is a Fed that really has an inflation problem on its hands potentially and has to respond.
The vibes are terrible. Record low consumer confidence. Whenever I see that number, of all the things that have happened over the last 4 or 5 decades, and this is the worst people have ever felt about this economy, I know that's what you, Mitch, tell us is happening right now. I struggle to internalize that, given how much worse it has been in the past.
At the same time, there wasn't doom scrolling in 2008. In 2009, people weren't in their bubbles of different political zeitgeists and understanding all the terrible things that were happening on the other side. That's where we live right now, so people feel pretty rocky.
And the politics, too. Doesn't it feel like a political poll every time we get these things from you, Mitch?
To exactly that point, the politics are so radicalized on both sides, and in those ecosystems, the world's terrible on the other side, or the world's amazing because we're in control. And that polarization definitely is underpinning the political backdrop, which does have influence over policies. Does it have influence over markets right now? Not so much.
The equity market is a better place. All-time highs on the S&P 500. Unmoved by the president's social media posts over the weekend, down by not even 0.1%. And I would add, the commodity market largely unmoved as well. Brent crude, WTI 104 on Brent, WTI at 98. I saw headlines about crude surging, and then I checked the price.
Yeah.
Up 2, 3, 4%. That is not a surge in this world.
You were like, that's child's play. Are you kidding? We've seen 10% in a day. What we are watching, though, is longer dated Brent talking up some higher levels as people price out the idea of this conflict persisting for longer. We don't know how to price this because we don't understand exactly how much spare capacity there is left that still is floating out there on the seas. That has become clear by spot price. Going forward, it's going to be the longer-term trajectory of how long it'll take to reopen the Strait #1, and as Aramco pointed out, what that means to normalize flows, whether it takes to 2027.
Let's get you the latest. Under surveillance this morning, the cost of conflict.
I'm concerned that we're draining our resources in a war in Iran, and China basically is just watching from the sideline. They're not sinking that money into the Middle East. They're sinking that money into building their economy. So what I want is for the United States to be putting our resources in investing in manufacturing here at home, jobs here at home, research and innovation here at home, and not getting sucked into the Middle East.
So here's the latest this morning. The president meeting Chinese leader President Xi Jinping in Beijing on Thursday. Trump will press Xi on his approach to the Iran war. Bloomberg's Mika Sona joins us now for more. Mika, welcome to the programme. Set the stage for us. The next couple of days, what it looks like in anticipation of this meeting.
Yeah, absolutely. I mean, this is going to be such a historic visit for U.S. president over a decade, Trump's visit to China. But it's going to be largely overshadowed by the Iran war. China and the U.S. have very different thoughts in terms of how to actually conclude this war. And the president is going in with weakened leverage. He does not have his tariffs. The global economy is being highly impacted by the ongoing conflict. So it's going to be, a very tumultuous visit, to say the least.
Mika, you say he has weakened leverage. He's maintaining a blockade over a key artery for energy that goes to China. Does that not put a bit of pressure on China to do something to influence the outcome of what happens here?
Yeah, I think that's what the White House is hoping for. And I know that some of the topics that are going to come up also is that China financing Iran, the relationship there, and potential weapons sales as well. So, we're going to see what happens. I know that's going to overshadow a lot of the other talks initially. I know that the president really wanted to focus on, trade, of course, and artificial intelligence. But, we're going to likely see this pretty much grasp the entirety of the visit.
Mika, appreciate the update. Mika Sona there, down in Washington, D.C. With us around the table, Rachel Ziemba of the Center for New American Security. She writes the following. President Trump hopes to change the conversation from the Iran war by visiting China and announcing some deals. Rachel joins us now for more. Rachel, good morning.
Thanks for having me.
Is it as simple as that?
I don't think it is. In fact, I had started to tell clients a couple weeks back that I wouldn't be surprised if the meetings got pushed back again. But then you would really run into the midterms and the like. It's interesting to me, Treasury Secretary Bessent is meeting with his Chinese counterpart earlier this week in South Korea. There still seem to be deliverables being worked out, right? We're expecting, this new board of trade, maybe a board of investment. They're supposed to do non-sensitive investment between the two countries. I'm not sure what fits in that basket of non-sensitive investment these days. And, as you say, there's still a war on, and China is hurting now, but they also are going to be a beneficiary of this trend towards more coal, more renewables, more batteries. And so I think there's a lot of different leverage going around.
This meeting was supposed to happen weeks ago and
Correct.
didn't because of this war. It's happening and the war is ongoing. What changed?
Well, it's interesting. So I think China actually wanted to have the meeting around this time of year. They didn't want to have it earlier in the year. So, I think part of what changed is, things have to go on. Also, President Trump is hoping that China will see in its own interest to bring the war to an end. And as I say, he's trying to reset and focus on trade and the like. Now, he's going in having just received a blow to his trade agenda and tariffs. The 122 ruling on Friday, I think it was. Now, I don't think that changes things a lot because at the end of the day, the administration was going to use Section 301 tariffs to bring them back up. But we're at a moment where tariffs on China are the lowest rate they've been for most of the second Trump administration.
Has anything changed in terms of the leverage that one country has over the other now versus when they were previously going to be meeting?
I think the main area is probably one of almost the political and strategic elements. I think what it was economists or others who have cited this, don't get involved with your enemy when they're doing something that undermines them. And I do think that was China's original focus there. What's changed now is that the economic costs, the real economic costs, are mounting, right? I was talking just before I came on to chat with you guys about how plastics and the downstream effects of this crisis are really increasing. You're right, Lisa, the oil and the water, we don't know exactly what those volumes are, but what we do know is that today we have countries ranging from India to Australia, big allies of the United States at times, are preparing for even more rationing. So I think the industrial impacts are mounting. In terms of leverage, if anything, China is trying to exert more leverage over critical minerals, critical supply chains, and that's something that the U.S., we have a time inconsistency problem about how to address those issues.
Do both countries have the same approach of trying to stave off any kind of political pain in the form of consumer displeasure about higher prices? In other words, is a response from both sides to subsidize different things and potentially increase fiscal spending?
Yeah, I think that's right. China, both sides and many countries around the world have that instinct. The problem is if you subsidize, then people continue to consume, and then you might end up with real shortages. So that's only maybe a short-term solution. Here in the United States, I think the instinct is to subsidize, but we actually haven't done much of it yet. The gas tax could be reduced. There are some different ideas floating around there. In China, they reset prices every month, so there can be some delays in passing that on. The other issue is China has made more strides than the United States to electrify as many things as possible. And so that electrification, using coal, using renewables, the U.S. government would like us to be using more coal, would like to convert more plants. But the challenge is also, you look at electricity costs, and China's been building out a lot more electricity capacity than we have in the United States. So I think the political sensitivities are different. And of course, we got the midterms coming up, right? And China doesn't, what the population thinks does matter, but they're not going to the polls and having to face the electorate with another round of supply chain restrictions and inflation.
Rachel, appreciate your time. As always, it's good to see you in person. Thank you. Rachel Ziemba there of the Center for a New American Security. To Rachel's point, to state the obvious, they care about economic stability. Of course they do, but they're not sensitive to the political cycle because there isn't one in China.
Which is one reason why some people say they can exert different types of pressures. That said, it was notable that PPI came in at the fastest in China going back to 2022, but CPI did not, because those companies are being forced to absorb those margins. So you are seeing some corporate pressure coming down the pipe.
That is a different world, without a doubt. Coming up, Ruqayya Ibrahim of BCA Research as crude trades back above $100 a barrel. Plus, Danny, how's your morning movers? Intel rising once again, this time on a potential new partnership with Apple. That stock is up by close to 7%. This market doesn't really blink, just about unchanged on the S&P 500. 6 weeks of gains. We talked about that weekly winning streak, the longest since October 2024. On the Nasdaq, all-time highs, up another 1/10% so far this morning. Beneath the index, just one story so many people are talking about, the move in semis, in chips. In the last 12 months, a move of basically 150%. Off the March low, a massive move. Just last week, after all the talk of maybe things getting toppy, we added another 11% to the rally and 5% on Friday alone. Just massive moves, and they're still building this morning.
They're underpinned by the idea of $800 billion of CapEx spend by the hyperscalers just this year alone. Next year, the total spending is expected to exceed the U.S. Defense Department budget. Just to give you a sense of the scope of spending and where is it all going to go? Buying chips to put in data centers, and that's the reason why people see this on a moonshot, frankly, going forward.
The team here at Bloomberg breaking down the numbers behind this equity market rally, the earnings. And we'll spend some more time on the earnings throughout today, but first quarter profits double what analysts expected. SocGen, 85% beat rate, the best we've seen in some 5 years. Quarterly profits have been flying. This is not just a sentiment story. There's something much, much bigger going on through the first quarter into the second and beyond.
Which is the reason why a lot of people are saying it's more of a liability not to be in this trade than to be in it potentially and see a decline in some of the prices. That's the reason why a lot of people are coming out and saying you have to be bullish. Lori Calvasino raising her price target, the idea of roaring 2020s from Ed Yardeni, and other people piling on because there is something fundamental happening under the hood.
Which is why so many people are ignoring this. This move here in crude. Crude up again by 2.5%, 104 on Brent, WTI on 98. Getting used to it, getting comfortable with it. That feels uncomfortable to me. But does this change the story? This move here, off the back of this move, yields up, across the curve, 2's up by 4, 392 above the policy rate, threatening to break out through 4%. Does that get your attention? Closer to 450 on 10s, will that get your attention?
Yeah, there's a boiling the frog element happening in the yield space. This isn't being driven also by just some sort of premium on top of inflation expectations. This is being driven by inflation expectations now. You are seeing on the longer end inflation break-evens starting to creep higher as people price out not only oil prices, but any policy response to it, with the idea of deficits possibly never coming down from where they are.
Yields up 3 basis points, the 10-year around 440. That's the cross-asset price action. Let's get you some single names, some morning movers. Danny Berger has more. Hey, Danny.
Hey, John, perhaps the poster child for that huge rally we've seen in semis. Intel up another whopping 6% in the pre-market trade. It was up 14% just last week on Friday. It did help, along with the whole melt-up over AI that we've seen, that there was a specific report about Intel partnering with Apple, maybe developing some of their chips. But this stock keeps hitting record after record. In just the past 10 days, it is up 50%. Now, not unrelated to the AI trade is Constellation Energy. They reported earnings this morning, not up a huge amount, considering there has already been optimism about this stock, but it is a winner of the need to power AI. They are the U.S.'s largest provider of nuclear energy. Their earnings beat across the board, a clean sweep of Wall Street estimates. Again, this is maybe an attractive area for the hyperscalers as they look for energy alternatives and clean energy alternatives. Finally, Moderna, also a winner in this morning's trade. Shares are up 8.5% in the pre-market trade, with now a confirmed U.S. case of the hantavirus coming from that cruise ship. There is no vaccine currently for it, but Moderna is in the early stages of working on one. It's also proof of concept, the idea that they can take their mRNA vaccine and quickly turn it around to try to address any sort of outbreaks we might have. So again, those shares gaining in the pre-market, John.
Nope. Danny, thank you. Appreciate it. More from Danny in the next hour. I just can't cover that story. There's a takeaway right now. Ban cruises.
I mean,
joking,
okay,
of course.
No, okay.
I'm joking.
I think
I'm joking.
The issue is stay on the cruise. If you have hantavirus or somebody on the boat has hantavirus, everyone should stay.
Sounds brutal, doesn't it?
It's sort of a perpetual cruise.
I was listening to someone on the radio the other day, and they said, you know, the bad thing about this is that, of course, it's taking place on a cruise. And I was thinking, that's bad. Like, isn't the solution obvious here?
Well, look, what I find notable is the number of people who are saying the cost that it would take for me to stay home again is so high. You'd have to pay me $1 million to stay home again.
Oh, my goodness.
To socially isolate for another 6 months.
Then we'd have a real deficit problem.
I mean, people are definitely done with that kind of response. So if we have another pandemic, well, I don't think anyone's going to really respond to it other than life is what it is.
Dark humour, but forgive us. You know, I don't think anyone really wants to cover this story right now. On our radar this morning, President Donald Trump rejecting Iran's latest peace proposal, calling it, quote, totally unacceptable. The Wall Street Journal reporting Tehran offered to transfer some uranium abroad, but won't dismantle nuclear facilities. Elsewhere, Apollo Global Management reportedly exploring a sale of its $3 billion fund, Midcap Financial. According to the Wall Street Journal, talks are ongoing, though a final deal for the publicly traded lender is not yet guaranteed. And finally, Alphabet, planning to debut a yen bond for the sale for the first time ever. This coming in an effort to fuel its aggressive AI expansion. The company has recently sold bonds in other currencies, including euros and Canadian dollars too.
Yeah, the race for AI spending is turning global as a lot of these companies realize that if they just rely on the United States, they will overwhelm the indexes and there will not be enough buyers who are willing to have a 50% Amazon or Alphabet investment grade index. So they're going to places like Japan, Amazon, preparing to issue Swiss franc bonds for the first time. They're all going around the world and everybody wants their bonds. Does it prolong the runway? I was thinking about what you commented,
sure.
Or does it sort of shorten it and potentially put a problem behind it? Only if yields go up significantly. How much is that the channel that some of the fundraising could pose a problem? If you start to see yields materially higher as a result of the backdrop with the war, as well as some of the commodity prices, does that challenge some of the fundraising, or is this the haven? Is this going to be safer than some of the governments because people have that much faith in the AI promise?
It depends by how much yields and rates would go up. Of course, that is a variable that's important to everyone. But these companies are particularly unique, highly rated, the likes of Microsoft. Out of everyone right now, who has the capacity to issue debt? These companies have tons of capacity to issue debt. So if you're thinking about runway, sure, if they want to, they've got the ability, if they've got the willingness to carry on issuing debt to fund this, sure. The pushback, the ROI. It's on the equity side of things. If you start getting pushback there, that I think things start to change pretty quickly. We're starting to see that in the margin with companies like Meta, Microsoft kind of getting closer to that moment, but we're not seeing that massive moment where the equity market just says, nope, no more, you're done here.
I feel like these companies have bigger market caps than most countries out there. If you look at, for example, the Alphabet market cap, it is twice the valuation of the FTSE in London. So you start looking at some of these valuations and you wonder when some of their yields might trade inside government bond yields.
We had that conversation last year, didn't we?
We're going to have it again.
Yeah.
I actually do think that we're going to end up having that conversation, especially if they do show the ROI on some of these investments.
We'll come back to that with Jonathan Golub of Seaport Global a little bit later in the programme, I think in the next hour or so. Let's turn back to our top story. Crude rising as the US and Iran remain at a stalemate on a deal to end the war and reopen the Strait of Hormuz. Ruqaiya Ibrahim of BCA Research writing the following: if the Strait is not reopened, markets will grow desensitised to the positive headlines and prices will increase to reflect a tightening oil market. Ruqaiya joins us now for more. Ruqaiya, welcome back to the programme. That quote, of course, was true last month and a month before, and we haven't seen crude explode higher. Why do you think we might be closer to that moment?
Good morning, Jonathan. Thanks for having me on. So I think as we move further out and the Strait of Hormuz remains closed for longer, what we're seeing now is that there's this buffer of massive inventories that are shielding the oil market temporarily. But ultimately, these are stocks and their ability to shield the market is not infinite. And as the Strait remains closed for longer, these inventories will continue to draw down. And that buffer is removed. And so I think that as we move into, further weeks and months ahead, if the Strait is not reopened, the path of least resistance for oil prices will be higher.
I'd really appreciate your best guess. So the blockade continues and the administration wants to put more and more pressure on Iran to hopefully get to a moment where they breach storage capacity and compromise their wells. Meanwhile, Iran's trying to sit this out. The blinking contest from their side looks like this. You've got all these inventories, and we're waiting for you to drive down your inventory so you feel the pressure. Who do you think gets where first?
That's a great question. So I think that, what we're going to see is that, Iran has proved to be quite resilient in terms of their pain threshold. And I think that, going forward, I would not count on them blinking in the face of greater pain. So I think what we're going to see is that the oil market is going to eventually bear the brunt of this. We've actually have seen quite a stable oil market for the past month or so. And, as I mentioned earlier, that just reflects, the buffer that we've had from the inventories, things like U.S. exports surging, China cutting back on their imports. But as this prolongs, these buffers are going to sort of wear thin and their ability to shield the oil market is ultimately going to weaken.
Ruqaiya, which of the Gulf countries are most exposed financially to the prolonged conflict, should it go on for a longer period of time?
Yeah, so Iraq is definitely exposed here. Their inventories were the first to be filled. And so they've had to shut down their production, quite a bit very early on in the conflict. The other Gulf producers, so for example, Kuwait has also shut down a big share of their production. Bahrain, similar situation there. And then the ones that have been able to sort of weather the storm better are the ones that have the pipeline bypass capacity. So that's Saudi Arabia and the UAE, which are still able to get crude out of their countries by bypassing the Strait of Hormuz through either the East-West pipeline or the port of Fujairah in the UAE.
Are there similar offsets, not just for crude, but for other commodities as well? Because we point to the fact that we are focusing on crude, but we're seeing, for example, cooking oil prices rise 5.6% in a month. This is affecting many other commodities. What's your sense of what else is getting through and how?
Yeah, that's perfectly correct. I mean, what we're seeing also is that there's a massive disruption to fertilizer, which of course is also a byproduct of the energy sector. And so that's translating into upside pressure on agricultural commodities. And also, things like the closure of the Qatar Energy's Ras Laffan plant is also a disruption to the fertilizer industry. And so, as this closure of the Strait of Hormuz prolongs, that also buffer where, you have sort of the planting season that's taking place, the spring planting season. And as the crops, sort of progress and the harvest season comes and that fertilizer is insufficient, that also poses a massive upside risk to agricultural prices and all those byproducts that come from that.
Brent Crude this morning around 104. Rakai, thank you. Rakai Ibrahim there of BCA Research. New note from HSBC. New price target on the S&P, 76.50 on the S&P 500. It was 7,500. The title of the piece, though, that got my attention. S&P 500 above 8K. It's possible. We outline higher.
This ultimately stems from the earnings picture, and we've seen this from one person after another as they point to just how much earnings have rocketed higher. Now it's up to NVIDIA. On May 20th, how much do they change the narrative in some way or just build on the idea that those profits just keep rolling in?
Tech could re-rate. IPOs set a higher bar for valuations. Laggards catch up as the geopolitical and trade uncertainties fade. AI efficiency gains broaden, margins expand. A Goldilocks backdrop returns as long-term interest rates fall. The path to 8K on the S&P.
Look, you can paint it even using the jobs report that we got on Friday. And this is something that Andrew Hollenhorst and the team over at Citi had pointed to. You're seeing wage growth tend lower and pretty consistently over the past, if you look at the 12-month rolling average. And if you look at that, you could see a pathway to the Fed looking at some of these inflationary pressures. It's transitory and seeing a path to cut rates, especially with the Kevin Warsh Fed. All of this is predicated on this conflict ending. And right now, we don't see a path to it.
Nasdaq futures up by a tenth. S&P 500 futures just about unchanged. Let's get you an update on stories worldwide this morning with your Bloomberg brief. Yahira has more. Hey, Yahira.
Hi, John. Pakistan is negotiating with Iran to allow Qatari LNG shipments through the Strait of Hormuz, with the first cargo since the war began already in transit. Pakistan, which is mediating between the U.S. and Iran, is struggling with a gas shortfall and battling widespread blackouts. Energy Secretary Chris Wright saying the Trump administration is open to suspending the federal gas tax.
All measures that can be taken to lower the price at the pump and lower the prices for Americans, this administration is in support of. We are constantly looking for different ideas. We've taken a number of actions.
The U.S. national average for a gallon of gas is $5.52, including the 18-cent tax, up about 50% since the Iran war started. And the New York Knicks are back in the Eastern Conference Finals after sweeping the Philadelphia 76ers. The Knicks advancing to the East Coast Finals for the second straight season and will play the winner of the Cleveland-Detroit series. That's your Bloomberg brief. John?
Yahira, thank you. Just want to confirm that is not why Annmarie isn't here. She's on her way to China. She'll be back with us in the next couple of days, delivering coverage from that. But I can tell you she's very happy about the outcome of that result over the weekend. Up next on the programme, balancing the dual mandate.
2 months in a row now, we've had blockbuster jobs numbers. Pretty much it was green across the board. And so what it means is it's a rip-roaring jobs market.
Up next, we'll catch up with Matt Hornbach of Morgan Stanley. We often play this game, If I Told You. If I told you at the start of March, Strait of Hormuz has just shut down. This will continue through to early May, but in early May, what you'll see is a series of people on Wall Street upgrade their price targets on the S&P 500. You'll be shaking your head. Why? Really? How? How's that possible? Earnings is how it's possible. We've seen a series over the weekend. Lori Calvasina of RBC, new 12-month price target, 7,900 on the S&P 500. Year-end HSBC now looking for 76.50. Not bullish enough, apparently, at 7,500. Ed Yardeni, he gets the headlines. He's looking for 82.50 now on the S&P year-end off the back of this powerful earnings story.
The earnings story has actually superseded even the gains that we've seen so far, even though they are absolutely moving into moonshot territory. At a certain point, people are looking to a question of when the Strait of Hormuz will open and the potential boom conditions that we would have had there not been some sort of constraint coming from higher oil prices. If that eases, then Eddie Ardeni unleashes the remainder of his roaring 2020s that evidently is more than half over.
The guys who really deserve the credit, though, the guys over at Barclays, Venu and the team, Ajay, raising the price tag on the S&P right in the thick of it, near the end of March, right in the thick of it, where things were getting a bit scary. And then they raised their price target higher, ignoring the Middle East and focused on the earnings.
Notable that they're getting more cautious now and actually going market weight because they think that maybe some of these gains have already reached the point where they can stay for a while.
Here are the scores this morning. Futures just about unchanged on the S&P 500. On the Nasdaq, going nowhere also. On the Russell, down by close to 0.1%. Crude is elevated, inching higher, Brent and WTI. And bond yields grinding higher as well, up by 3 basis points on 2s. Likewise on 10s, your 10-year 440. The Fed in focus, under surveillance this morning, balancing the dual mandate.
2 months in a row now we've had blockbuster jobs numbers, and the really interesting thing is that we look at these things that you guys do too, I'm sure, called heat maps, where you look by category, like where's the green and where's the red, and pretty much it was green across the board. And so what it means is it's a rip-roaring jobs market.
So here's the latest this morning. With the job market showing solid signs of gains, Fed officials are turning attention to a fresh batch of inflation data due out through this week, starting with CPI tomorrow. Joining us now is Matt Hornbach of Morgan Stanley. Matt, good morning. Good to see you.
Good morning. Thanks
Set the
for having
stage for us. What are you expecting from CPI, PPI, the inflationary reads this week?
Yeah, so this month we're definitely going to have a bit of a spicier inflation report. Ultimately it matters how all of these inflation numbers that we get this week come together to form a PCE inflation forecast. So we've got CPI, PPI, import prices. All three of them contribute in their own ways to what we end up getting in PCE. And of course, that's the important number for the Federal Reserve. That is the inflation metric that they are targeting for now. Perhaps, for now.
You think that changes?
No, we don't. I was just baiting you a bit.
Don't bait me and then say that. Kevin Walsh suggested maybe in his hearing that things might change.
There are 1,000,001 ways of slicing and dicing inflation data, and if you take out enough of the line items, you will get the number that you want to get. I do think, though, that there are some really interesting research notes out there that do look at different types of trim mean measures of inflation. How are you supposed to trim one side versus the other? It's a fascinating topic, and I actually look forward to any research that the new Fed will end up delivering to us.
The fear is that the new Fed will look for a framework that can give it a green light to be more dovish in the light of inflation that still is running hotter than expected, but also that isn't necessarily transitory. How much is the market pricing that reality in right now?
So when we look at CPI fixings, it's a smaller market. It gets a lot of attention from people that do a lot of work on inflation. You actually see inflation coming down in that market price quite a bit into the middle and end of the year. The question is, how much of that decline in inflation that's priced into the market is truly an expectation amongst investors? How much of it is risk premium amongst investors? Because we know oil prices are moving quite a lot every single day, and they can have a big influence on the path of inflation into the end of the year.
Okay, I understand all of that and why you could say that's transitory, why it has been in the past. At the same time, if you look at core PCE, the key metric that the Fed looks at, it actually is rising faster than CPI, and it's on the heels of a lot of the infrastructure spending by the hyperscalers. This is the AI trade coming out in higher inflation that is going to be passed along to people in the form of higher goods in different pockets. At what point do you have to look at that and say structurally there is a higher inflation embedded in here, regardless of oil prices?
Well, this is a good point, because it's not entirely clear that companies are passing on as much of these additional costs as you might have otherwise thought. Remember, a year ago, right after Liberation Day, many in the economics profession thought that companies were going to pass on all of the tariff-related costs. And what we have seen is that they did not do that. They maintained their profit margins. They actually leaned on their labor force in the form of less hiring, in the form of increasing wages at a lower or a slower rate than what they had done in previous years. So companies actually did not pass on as much of the tariff-related costs as people originally thought. And the question then becomes, what about all these additional costs that now companies are facing? Energy costs, costs related to building infrastructure, related to AI. How much of those costs are they going to be able to pass on? The labor market has almost produced no jobs over the past 12 months. So in some ways, it's become more difficult, we think, for companies to pass on these costs than it was 2 or 3 years ago when the consumer was getting a lot of money from the government, allowing them to absorb those costs much more easily than they can today.
Do you think this Fed sits this out for the rest of the year?
So that is our current forecast, that the Fed stays on hold with the funds rate at 3.75% upper bound, and then we start to see some rate cuts in the first part of 2027.
What's driving that? Unemployment, inflation, one side of the mandate versus the other, both?
It's definitely the inflation side of the mandate. We don't see the labor market cracking. We do see inflation coming down, in some ways very much in line with how markets are pricing the inflation point of this outlook. And so if you get the lower rates of inflation, then presumably the Fed will continue to lower rates a modest amount from here.
Matt Hornbach of Morgan Stanley. Matt, thank you. Appreciate it. Setting the stage for a Fed to do nothing in the year ahead.
Which is consensus right now. Does Kevin Warsh have the space politically to do nothing? And does he have compatriots who are willing to do nothing? And does signaling matter, right? I mean, if they do nothing with a hawkish bias, potentially of a hiking bias, is that very different than staying on hold with an easing bias, even if eventually the next move is a cut?
Doing nothing in an environment like this one is dovish. Without a doubt, you're maintaining an easing bias. I think that's massively dovish.
Although,
inflation at 4, unemployment at 4, growth is robust, and tech companies are spending like there's no tomorrow.
If Matt's right, though, and essentially companies can't pass along the costs, so you don't get much higher inflation, that's going to cause margin pressure. And that's an argument for bonds over stocks, which I've not heard anybody make, truly, because that's going to be negative for stocks, and that's going to be negative for the earnings. So far, the earnings have actually kept pace. They have been able to pass along all those costs. Is that starting to change, given the hiring backdrop?
Can I stop worrying about the deficit, then?
Can you stop?
Yeah.
Well, my father asked me that last night.
You just made an argument for bonds for it.
Well, you know, I can make an argument any which way. I'm just saying if that's true.
Stop worrying about the deficit.
Thank you. All right. That's the message to Bramo's dad. Stop worrying, from Matt Hornbach of Morgan Stanley. Yields up this morning by 4 basis points. Up next, Jonathan Golub of Seaport Research Partners. The third hour of Bloomberg Surveillance around the corner.
I think we're in the midst of a massive AI opportunity.
What we're seeing in financial markets, it's just much more about this AI theme.
The story clearly within tech is semis.
We're very constructive on the market. We still think this is a risk on tape.
I think the market's generally okay.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now, and your scores look like this. All-time highs on the S&P 500, just about holding on to those gains from last week. 6 weeks of gains. On the Nasdaq, up this morning by 0.1%, and the rally in chips continues. Check out Intel in the pre-market. Turn to crude. We're ignoring this on Brent and on WTI. Inching higher. The president saying the Iranian proposal is totally unacceptable. Brent at 104, WTI at 98. That's driving this move in the bond market. Yields up again across the curve. 2's up to 392, 10's up to 439. Going into inflation data through this week. CPI tomorrow, PPI after that. The Federal Reserve firmly on hold at the moment. That's unlikely to change, but that is not changing the bullish view on Wall Street this morning. Already from Friday, RBC, new price target higher. Over the weekend, at Jardini, new price target higher. This morning, HSBC, new price target higher.
And this is on the heels of earnings that have come in better than expected again and again. Yes, it is being fueled by big tech, but it's not just coming from big tech. It's also coming from some of the retail sectors, particularly from the biggest firms that can actually absorb some of the costs better. We're seeing nodes of productivity in a number of these companies. The picture's been incredibly rosy with this particular earnings season. There's only 17% left to go. A lot of that is NVIDIA on May 20th. If you get more of the same, do you get more upgrades to the Ed Yardeni heights of 8,200.
People piling in. The melt-up continues in chips. The moves we've seen there, amazing. We've gone through the numbers a few times, up 150% in the last 12 months. Big chunk of that coming in the last 30 days or so. Regret minimization. Year-end, where do you want to be? We reflected on this question earlier on this morning. I think it's an important one. How do you want to be wrong if you are going to be wrong? Do you want to see this market go up another 20% and not be part of it? Or drop 20% and be part of it?
You asked me this before, and I said probably the upside, that you don't want to miss the upside rally. I would add to that that right now the inflationary backdrop will not run away. It's not 9%, but the idea that it's at 3 or 4%, even potentially by year end, means you're not getting paid to be in anything else. Are you going to go to cash? Are you going to go to gold? Are you going to go to bonds? Where else do you go if you ultimately want to keep pace and get some returns? That's the reason why people are still being pushed into risk, even though you could argue that rates are relatively high versus the pre-pandemic reality, at least since the financial crisis. So you're looking at that, and that's part of what's pushing people to be buyers even at these high levels.
Not for me to say that there isn't a bear case, just to line up where things are right now. Fed has an easing bias. Unemployment's close to 4%, data's okay. Earnings are super powerful, and tech companies are still spending. How do you fade that? That's the challenge for the bears right now. That's the challenge.
I know, I hear about it. And it's, look, if you're a bear, here's the potential saving grace for you. You've been blown out. You've really lost a lot of money. The bear case is that potentially you get consumers starting to feel a pinch, and they cannot absorb the costs, and companies can't absorb the costs any longer without necessarily cutting their margins. Then you have reality biting some of the earnings, and what we saw so far in Q1 earnings was backward looking. That is the bear case that has to come through, especially with a spike in crude.
We do have this uncomfortable moment in the Middle East right now. The president saying the Iranian proposal is totally unacceptable, and yet no follow-through, not communicating what the next steps are. It's an odd quiet in the story this morning.
Yeah, the bar is getting lower for potential military action in response. At the same time, right now, the blockade is holding firm, and that quiet is enough for people to move on.
Crude up 3%, 104 on Brent. Equities just about unchanged. Coming up this hour, Jonathan Golub of Seaport Research Partners as stocks notch a 6th week of gains. James Steele of HSBC on gold's safe haven status, and Nancy Lazar of Piper Sandler on a resilient U.S. economy. We begin this hour with stocks holding near record highs despite renewed tensions in the Middle East. Jonathan Golub of Seaport Research Partners writing, the theme is the same, a market driven by earnings, not speculation. Jonathan joins us now for more. Jonathan, good morning.
Good morning.
Good to see you. Let's do the earnings story. How powerful has earnings season been so far?
I mean, earnings grew 21% this earnings season, and we're expected to see something it's not that strong for the full year, but maybe it'll be 16 or 18% for the full year. I mean, the consensus is for 21% for the whole year. I want to get back to something that Lisa was saying. You're saying, like, give me the bear case. And it's not normally like you, but let me tell you a couple of things that I think that maybe we're not thinking about. The semis names are booking revenues, but when they sell it to a hyperscaler, they don't take the expense, they amortize it over 4 or 5 years. So you book all of the revenues on the semis, but the hyperscalers do not book the expense all at once. That gets spread out over a long time. So the earnings, the earnings picture forward, if you wanted to build a bear case,
please.
It's that the hyperscalers have more weakness to go on the earnings that is not coming into the numbers. I'll highlight something else on the energy side, and the energy earnings look unbelievable for the rest of this year. But the futures curve is saying that oil prices will eventually roll over. 3 or 4% of the upside of earnings in the last month or so has been higher oil prices. And the assumption the market has now is it benefits the oil companies and it doesn't hurt the consumer and it doesn't hurt industrials. Now, right now, the economic data is saying that's true. But if you want to build a bear case,
please.
The bear case would be that next year you're going to see a rollover in the energy story. And that hasn't yet. That's not really in the.
This is the
in
happiest
the
Lisa's been all morning.
Well, I've never heard Jonathan Golub.
I came prepared for this.
Fantastic! It's really great, John. I mean, honestly, when has Jonathan Golub ever come in here and said, "I want to, I'll help you build a bear case"? I was expecting hate this morning, but no, this is fantastic.
Well, but mind you, there's a 21% growth rate, and we know trees don't grow to the sky. This is, the only time we see growth like this is when you're leaving a recession and everyone underestimates the bounce off the bottom.
Recoveries.
Yeah, recoveries. And this is not a recovery story. And also, you're right, in the earnings season, it's kind of everywhere. The financials
Okay, so I'll give you another kind of like bearish tilt. The financials are just crushing it, but a lot of that was on first quarter trading activity. And when did the trading happen? In the month of February, leading into the war. It has not carried through in March and April because once investors got positioned. Now, I'll give you the other side to a question that you were asking.
So we don't need to ask any questions.
No, I was listening to your segment, John.
This is fantastic.
But, you were kind of saying is, would you rather be wrong to the upside or wrong to the downside?
Yeah, what do you think?
The hedge fund community has so massively de-risked. They've said we would rather protect ourselves on the downside than participate on the upside. The upside risk here is that the hedge fund community is so under risk that if things resolve themselves reasonably, that they end up re-levering into this and you get a really big upside. On the themes that we're seeing.
So are you bullish or bearish? I mean, where do you line up on this?
I'm throwing your bone.
Okay,
no, listen. But I do think that it's really important that you calibrate these things. But no, I think things are strong. I do think that the hyperscalers are going to be facing more of an earnings headwind than is in there because people don't understand the accounting that you amortize these expenses. They're not flowing into the earnings right now. But the semi story, it looks quite real.
So I was struck by this report, this paper that came out in the past couple of weeks, and Torsten Slok pointed to it over the weekend in his weekend reading, which I love having, talking about how a lot of companies will not replace humans with AI yet because the humans are cheaper right now than having the AI solution. How much are you not seeing the adoption that could come? And frankly, the return on investment being explained by just the average company in a way that can justify some of the spending in the near term, that can continue the financing to semiconductors in the near term?
Well, I also think that in the near term, you have these legacy systems that underpin our businesses that you're not just going to turn off quickly. So you're keeping the staff to maintain these systems while you hire teams of young people to do this new AI work and kind of replace your code. So I don't think you're going to see. I mean, look, you see the employment data. The employment data is not saying everyone's more efficient because of AI. Fire everybody. The employment data is saying yes, we need the old staff, and then we need people to help transition and build new platforms and the like. Eventually, we're going to become more efficient. But right now, this is a build story, not an efficiency story.
What should we ask next, John? I'm joking. Look at the moves in chips this morning. Intel up again. This mount up continues. I'm getting questions from Bloomberg subscribers to ask you, so I don't have to ask anything this morning, clearly. On chips, how cyclical is that sector? Typically, it's boom, bust, and now it feels like we've got these massive secular tailwinds with short capacity. Everyone's trying to build things out. How long's the runway? How cyclical is this story?
This is like the debate when we get together, clients in a room together. It is more cyclical than over the long run. There will be cyclicality in these, but when you're building out anything that's new, you lose the cyclicality for the secular trend. The CapEx cycle is so strong that there will be cyclical demand again, but it may be cyclical demand in 2028 or 2029, and it's not cyclical demand in 2026.
When do people start to care about that?
When?
When do people start to care about that?
Well, these things always will carry a lower valuation, a lower PE multiple, because there is cyclicality in these things eventually. But right now, the multiples on these are so low. They're trading so cheaply because the earnings are great and people say, yes, but they're cyclical, and these things are on sale.
What do you think is the most fragile piece of the demand backdrop for the AI ecosystem right now? Is it the spending commitments of the OpenAIs, the Anthropics? Is it the spending, the total CapEx intentions coming from the hyperscalers? Where do you see the weak spots, the weaker links?
Well, I'll tell you what I see maybe the opportunity here is there are a number of areas that have just gotten mercilessly beaten up. And I'm thinking about software because there's assumption that these companies are going to get put out of business and that there's no terminal value. And there's been no differentiation whatsoever between those software companies that are going to continue to be success stories and those that are going to fall apart. And there's more opportunity in software than anywhere else in the market to pick those winners. The market has basically sold everything down together, and it's a real opportunity.
Jonathan, it's good to see you. Thanks for being here. Appreciate it. Jonathan Golub there of Seaport Research Partners with one foot in the bull camp and one for explaining the bear thesis.
Well, explaining that he acknowledges that the bear thesis can be made, and the reason why he can ignore it is because he can come out with the counter arguments, which is just an incredible valuation story. When you ask where are the weakest links, he tells you where the biggest opportunities are, which gives you a sense of the sentiment. And frankly, he's not alone. A lot of people agree with him.
I noticed the same thing.
Yeah.
I just like John. I didn't want to push back. You never answered the question, but it doesn't matter. Up next on the programme, we'll get you more on these big moves. We'll hear from James Steele of HSBC as well. In the meantime, let's get you an update on stories elsewhere. With your Bloomberg brief, Yahara has more. Hey, Yahara.
Hi, John. The U.S. and Iran failing to agree on terms to end the war. President Donald Trump calling Iran's response to the U.S. proposal, quote, totally unacceptable, but leaving it there with no new details on the path forward. The fragile month-long ceasefire, though, appearing to hold. The president planning to press China's Xi Jinping over the war in Iran when they meet in Beijing later this week. Sources telling us here at Bloomberg, Trump will bring up the money China provides to Tehran and potential weapons exports. And UK Prime Minister Keir Starmer says he'll contest any leadership challenge amid calls for his departure after a big loss for Labour in local elections. Starmer saying failure to get things right on the part of his party could allow populist forces to steer Britain down a dark path. That's your Bloomberg brief. John.
Yahara, thank you. Thanks for the update. Up next on the programme, the Morning Calls plus James Steele of HSBC on gold's safe haven status. That conversation just around the corner, live from New York City this morning. Good morning.
Just look at this market, it's really strong. It's driven by earnings momentum, and that earnings momentum is driven by this technological change that's coming through. If you see that cash flow coming down, coming under pressure more generally, that's when you start to see the stress emerging in these bubbles. We're cautious, but we're not bearish.
How many times have we heard that this morning? Ian Harnett there of Absolute Strategy Research. We caught up with Jonathan Golub just moments ago, who volunteered the bear case for equities before telling us he was bullish, and this is why.
The bear case actually is quite convincing. I was really sold. Just, I know everyone's shocked, but I was
low
really
bar for that, Bramo.
Well, I mean, honestly, his point was actually a really good one. I have to look more into this. The idea that a lot of the hyperscalers are not booking the costs, even as the semiconductors book the purchases and the profits. So there's a mismatch here in the understanding, at least in a financial accounting method, of how much they're actually spending at the same time that bond investors are having to spend billions upon billions of dollars.
Fixed income investors getting a little bit queasy about how much they are funding right now.
If they are, it's not showing up in their bids, and that, I think, is becoming an issue. So at what point does their queasiness get expressed in some sort of pushback?
Not seeing any queasiness or pushback right now at the equity market level. At the index level on the S&P 500, record highs into the weekend this morning. Futures negative by just 0.1%. On the Nasdaq, down by 0.1% also. I want to turn to crude just briefly. Brent and WTI inching just a little bit higher. Talked a few times already this morning about this uneasy, uncomfortable calm. The president saying the Iranian proposal is totally unacceptable, but not outlining his next steps or what happens next in any way, shape or form.
And the market's sort of taking this as status quo, that the blockade will remain, and most people do not expect any kind of military action in the near term, especially not when there is a meeting between President Trump and Xi Jinping of China. Key question to me, are people looking for deliverables from this summit between the Chinese and U.S. leaders, that there might be some sort of leverage exerted in this Iranian war, or are people just ignoring it because they cannot analyze it, and they have been absolutely overwhelmed by the physical crude capacity that was left, that did sort of put to bed some of the most bearish or bullish, I guess, calls on oil?
Yes.
Thanks.
Without a doubt, the last one, right? That's what it's felt like for a long, long time now, particularly the last several weeks.
How do you analyze something that is not analyzable? You can't predict this. You can't get an edge, so people are ignoring it and focusing on semiconductors.
With that move in crude, yields up. Intel 2. Yields higher this morning, up by 3 basis points. The 2-year, 392.10s at 439. That's the price action. Here are your morning calls. First up, UBS downgrading down to neutral, saying positive demand is already priced into the stock. Your second call from Bernstein raising its price target on Delta, citing better fuel insulation. And finally, Argus upgrading BP to a buy, citing increased upstream production and strong oil trading contributions. That name is up by close to 2% this morning. Let's talk about commodities. Let's talk about gold. Retreating as the US and Iran failed to reach a peace agreement. James Steele of HSBC writing, the slide in gold should be viewed in terms of the liquidation, not as evidence that gold is no longer a safe haven. James joins us now for more. James, good morning.
Good morning.
I want to give you some space just to explain what you mean by that quote.
Well, I think bullion came in for some, and I'm not an apologist for bullion just because I'm the precious metals analyst, but it did come in for some criticism that it didn't rally in the wake of the strikes on Iran. It rallied the first day and then has proceeded basically to decline since then, more or less. And really, that's because gold is, in addition to being a safe haven, it's also an insurance policy. And the decline in equities that happened just after the war and the higher oil prices combined with yields, all of which strengthened the dollar, really prompted liquidation in the gold market, especially with the equity weakness when it was necessary to raise cash for margin calls. So gold did what it's supposed to do, which is to provide you with a safe harbor and cash when you need it.
We should probably define what a safe haven actually is then. Because typically, I think for myself, I'd be thinking, how does it correlate with risk assets? What happens if stocks go down? And if it correlates positively with risk, then I would question whether it is a safe haven. What is the definition of a haven?
Well, I think a safe haven is a mixture of a quality asset, plus the fact that it is not as correlated with paper instruments, which gold traditionally is not over the long term. I mean, you look at today, for instance, oil is up 3%, but gold is only down 1%.
If you say it's a liquidation feature, who is liquidating? A lot of people thought it was central banks, but from what you were saying, it sounds like it was a lot of hedge fund liquidation, and the hedge fund element is changing the dynamic behind the precious metal. Would you say that that's true?
Well, there's certainly more entrance into the market. So broadly speaking, yes, we did see some central bank selling, but really what we saw as regards central banks, China remained a buyer. The latest data, at least anyway, shows that China remained a good buyer for the latest monthly data that we have. But some central banks stopped buying, and they had been a keystone to the rally. So the removal of a positive can also be viewed as a negative. So even though they weren't selling heavily, except for a couple, the fact that many of them were no longer buying had a negative impact. But we had a lot of fresh money coming into the gold market for well over a year. And there's asset managers, portfolio managers, hedge funds, some of which had not traded gold for a while. And some of them have liquidated. And that, I think, was a larger element of the decline.
So hedge funds and asset managers of various types are now the marginal price setters of gold. Is that fair to say? Which kind of, if that were true, sets a very different dynamic behind the precious metal than perhaps has been the case in years prior, no?
Well, and I'm old enough to remember when jewelry was the dominant factor in the gold market. In the 1990s, jewelry was very important. And now we've seen double-digit declines in the jewelry market for the last couple of years, and it hasn't seemed by itself to dent the rally. We've also seen more mine supply. And those factors up until recently haven't dented the rally. It wasn't until the investment demand declined that this spare bullion on the physical market, made more of an impact on prices going down. But I think it's fair to say that those players have always been the marginal factor in the market. Investment moves in and out of the market very quickly compared to, particularly in the futures markets, more than the ETFs and the OTC markets than traditional jewelry, coins, bars, and mine supply.
Can we get some more detail from you on the central bank buying? That's been a massive tailwind for this particular trade. Many of these central banks, these economists right now, face, say, terms of trade shock. And to your point, they need to accommodate that, and they certainly don't want to be reducing their exposure to their own domestic currency by selling whatever, by buying gold, for instance. So can you walk us through what's going to happen once this war ends with that central bank buying?
When the war ends, I think that, and assuming that oil prices then moderate and the dollar maybe takes a back view rather than being as strong as it is now, I think we're likely to see a resumption, at least at some level, of central bank buying. Now, for 2022, 2023, 2024, they bought 1,100 tons, just shy of 1,100 tons each of those years. And if you look at it in terms of mine production, it was almost 1 out of every 3 ounces that came out of the ground went into a central bank vault. That's an enormously, that was double the previous 10-year average. And that cooled quite a bit to 860 odd tons last year. And we think it will cool further this year because we haven't seen a lot of buying so far. But central banks tend to have long-term strategies. A number of central banks have published position papers on why gold is a good thing to own. And assuming that the US will continue to run a current account deficit, we will export dollars. Those dollars will accrue in central banks that we are running a current account deficit with. And one of the things those central banks may buy, assuming that they don't use it all for other foreign exchange instrument or fixed income instruments, will be gold.
James, appreciate your time. As always, thank you, sir. James Steele there of HSBC on a gold trade that's come a little bit undone over the last few months.
I can't help but wonder what some of these gold vaults look like in all the different places. Do they all have
Wasn't the president asked about Fort Knox recently?
Yeah, so
he was, yeah.
Take you to ours. I could have.
I would love to
a year ago.
Okay, well,
the insurance policy changed.
Oh, you can't take us in anymore.
No.
Oh.
Maybe you guys. I don't know. I'll ask.
Let's figure that out.
But to me, can't you imagine different themes? You walk in.
Wasn't the Treasury Secretary going to take us in?
And honestly, I would love to, just to shine the steel-toed.
At the Austrian Central Bank, there used to be a gold bar in the entranceway, in the hallway.
And you had to pick it up?
Yeah, you could put your hand in and you could pick it up.
Or not pick it up.
It's the first gold bar I've ever held.
Yeah?
It's ridiculously heavy.
Was it a good weight?
Much heavier than I thought it would be.
That's why you have to wear steel-toed boots.
Right? Yeah. It's crazy, crazy. Yeah. Up next, Nancy Lazar of Piper Sandler. Equity futures on the S&P pulling back just 0.1%. The opening bell about 1 hour away. On the Nasdaq at the moment, also negative, but not by a lot, not even by a tenth. The Russell just about unchanged. The gains continued through last week. We had some more weight to the rally, and this move in crude does not upend it. Brent and WTI shifting higher by just a few percentage points. This is the issue right now. So many people have become desensitized to the headlines coming out of the Middle East. Even the crude market in both directions.
And what you're seeing right now is the glut on the seas that has been able to offset some of the losses in production. A belief that things will get resolved, possibly now by June or July, if you take a look at prediction markets. And the fact that a lot of people think that maybe you can find alternative routes. At the same time, everyone's just focused on the story they know, which is that AI is changing our world and people are spending a lot of money on it, and that's why they're piling in.
Those inventories just sitting on top of prices right now, just keeping things contained. Just about. That move in crude, push it through fixed income. The grind high continues. 2s, 10s, 30s, yields up 3 basis points this morning, 391.60. And that right there is the challenge for the incoming Fed Chair Kevin Warsh. Kevin Warsh faces a committee that's divided and split, an unemployment rate that's close to 4, CPI, which later this week might also be close to 4. They've still got an easing bias, and the market is telling you, nope, you're not cutting. In fact, we're going to have 2s above the policy rate. That's notable.
Treasury Secretary Scott Bessent gave him a pass, Kevin Warsh, that he could potentially sit on his hands when he comes in. His challenge is going to be laying out why they should maintain an easing bias, given the fact that inflation is running hotter than expected, and the rates where they are do not seem to be constraining growth. I am curious, though, about the Treasury's response, and I do think that the auctions this week are going to be interesting. We do have $42 billion of 10-year notes being sold tomorrow. If you start to get messy auctions, how much is it? Over to you, Scott Bessent, to see how you are going to rearrange some of your issuance plans to offset some of the creep higher that we're seeing in long-term yields.
You mentioned Dan Iverson, PIMCO's very own legendary investor, to the Financial Times over the weekend. You're going to see more tightening as it looks today in Europe, the UK, and maybe even Japan. I wouldn't take it completely off the table for the US either. Now, there's people you listen to in financial markets. There's people that I understand you sort of turn the volume down for. I get it. Dan Iverson is the kind of guy you turn the volume up for. For him to say that, I think it's important and to some extent reflected, that risk just slightly reflected in this yield curve.
So PIMCO is looking at the potential for the next move to even be a hike, and it's remote right now, but the potential, as Dan Ivison laid out, he's not alone. Bank of America pushing back their first rate cut to 2027. Goldman Sachs pushing back their first cut to the end of this year. Everyone just saying the bar to cut is that much higher, and potentially the bar to hike is getting just a little bit lower.
Just a little bit lower, that's for sure. That's the cross-asset setup. The opening bell some 60 minutes away. As we count you down, let's get you some morning movers, some single names. Danny Berger has more. Hey, Danny.
Hey, John. The excitement over semis continues this morning until some of the heat of the biggest of its rally in the pre-market taken off, but still up 4% after a huge rally last week, again, alongside the Philadelphia Stocks Index, which is sitting at new records, as is Intel. It got a little extra of its own boost with some reporting on Friday that it was reaching an agreement with Apple to supply it with some chips. So again, those shares up 4 1/3%. Elsewhere, we have some of the constituent changes official for the NASDAQ 100, and Lumentum is going to be added to it. This is an AI photonics company. I wish I could tell you exactly what that is, but something with optics necessary to power AI data centers. So, of course, it's a hot stock. It's up about 30% this year. So that gets added to the NASDAQ 100 and gets a lot of passive flow alongside it. Finally, Circle out with earnings, a clean beat for them. Shares up 1.8%. They saw record transaction volume in the first quarter for their stablecoin, USDC. They're also deploying an AI agent that will allow you to buy, trade, whatever you want to do, and transact with their stablecoin. So those shares up just under 2%. John.
Danny, thanks for the update. Looking forward to the program. Danny Berger taking things over in about 30 minutes' time to guide you into the cash open just around the corner. Investors are waiting a big week of economic data with CPI and PPI just around the corner, plus retail sales later this week as well. Mike McKee has a preview. Morning, Mike.
Good morning, John. Well, we're going to make you pay attention to the economy again, maybe put the war to the side for a bit unless something happens. We've got a big week ahead, especially for Fed watchers. We get Kevin Warsh's confirmation vote sometime this week. The Senate is expected to vote to end cloture on it tonight, and then they could vote any time. He would take over on Friday, the changing of the Fed guard, as the new chair, Stephen Myron, would fall off the committee. We also have a lot of eco reports on inflation, starting tomorrow with the Consumer Price Index. Going to be very interesting because this one's going to have some twists to it. Everybody's going to be looking at gasoline prices, but it's not just gasoline. We're going to see a rise in owner's equivalent rent, the cost of housing, based on a statistical data quirk that comes from the month of October, when the government had to leave the number unchanged because of the government shutdown. So we're going to see an artificial rise in the CPI. Wednesday we get PPI, and then Thursday import prices. So 3 days of inflation numbers in a row. Thursday is also retail sales. Little early, but are we starting to see gasoline prices eat into consumer expenditures? That's going to be the question everybody's looking at. Friday, we get some manufacturing reports, the Empire and the industrial production numbers. So a lot to watch for this week, beginning with maybe the vote on Kevin Warsh and ending with Warsh taking over as the new Fed chair.
Mike McKee setting the stage for the week ahead. Mike, appreciate it. Thank you. Nancy Lazar of Piper Sandler writing, the Iran war could keep headline inflation elevated, but core inflation is set to slow. Nancy joins us now for more. Nancy, good morning.
Good morning.
Let's start with the inflation backdrop.
Sure.
Core inflation is set to slow. What's the reason for that?
Well, I'll start at the top, which is unit labor costs. It's a combination of compensation, wage inflation adjusted for productivity. Everyone talks about productivity, but not about unit labor costs, which is an offshoot from that. And looks like in the first quarter, we don't have official data yet, but looks like in the first quarter, unit labor costs probably increased only 2% on a year-over-year basis. They were a good signal back in 2020, 2021, when they also accelerated sharply up towards 6%, confirmed the acceleration in core. That's just not happening today. So it's really the productivity story coupled with still moderate wage gains or core inflation. That would be at the top of the list, core inflation to slow. But in addition, you have the shelter component. It'll be a little bit of a sticking point in the April data, but shelter inflation is also set to slow. And then tariffs. The tariff rate for now is down. And so we're likely to see also some disinflation, if not deflation, actually, in some of the core goods.
Just to extend that just a little bit,
Yeah.
Is that also another way of saying that consumer price tolerance is lower now versus 22?
Oh, absolutely. This is nothing like 22. Contrary to the University of Michigan survey, which suggests this is worse than 22, this is nothing like 2022. You had the monetary conditions and fiscal policy conditions to support the surge in inflation. Milton Friedman always says inflation is indeed always a monetary phenomena. Money growth has picked up some, not aggressive. It's about 4.5%, 5%. You were double digit in money supply growth after the COVID crisis.
So if you're not increasing hiring in any way already, and you've already cut some of the hiring plans in order to offset some of the higher costs, which is what a lot of companies have done, right? They haven't necessarily sped up hiring, and you're not able to pass it along to consumers in terms of higher prices. At what point does this hit margins?
So let me pull apart what you just asked a couple of different ways. First, companies are hiring. Private employment, based on the payroll employment data, was a record high in April. It also hit a record high in March. There was some skepticism about that. They revised actually March data up. Unemployment claims are clearly in a declining trend. They are the single best economic statistic. We have data there through late April into early May. Indeed, even claims are suggesting the employment backdrop is under pressure. The answer to your question is productivity. Again, I don't mean to be redundant, but companies are focused on productivity. They're becoming more efficient. I do think some companies could see profit margin squeeze, no question about it. If you are a consumer company, if you're a low-end consumer company, and you are trying to support your profits through higher prices, you're in trouble. What we're seeing in a lot of the restaurants, I'm out of my league here, but a lot of the restaurants, they're cutting prices because they know they at the same time they have to support that spending for the lower consumer. But what I don't know is what kind of new technologies are these consumer companies putting in place to indeed improve their productivity. So productivity is really underappreciated as a major support.
There are two ways to view productivity. On one hand, post-pandemic, people just were forced to do more with less. Yeah. And companies all realized they had to. And so it led to a wave of productivity that has continued today. And then there's another view on productivity, which is that AI is already making gains, and you're seeing that come through in the productivity numbers. Which is it?
Well, I lean towards more the latter, but it's not just AI. It's utilizing other tools, other technology tools that we've been using forever to also improve our productivity. Without productivity, you can't improve profitability. I gave you Germany. They have not improved productivity for the past decade, if not longer. They have no employment growth as a result of that because they can't improve their profitability. So there are two stages to productivity. Coming out of recession, productivity surges, or out of a slump, productivity surges because growth is stronger than employment. But as you move through the cycle, what's really impressive, and this is what happened in the 1990s, you get both. You get stronger productivity and you get employment because profits are so strong. In the first quarter, S&P 500 earnings are on track to be up 25 to 30%. So the profit backdrop is definitely supportive of stronger jobs.
Is Walsh cutting rates this year?
I don't think the Fed needs to cut rates. Again, you have already somewhat accommodative monetary policy. The Fed has cut rates 175 basis points. Money growth is accelerating. Bank loans have picked up. HELOC loans have picked up. And we have roughly 2% fiscal support for the economy. And so we actually calculate 4% GDP from both monetary and fiscal support for the economy here in 2026. The last thing we need is additional monetary stimulus. The combo of the two, obviously 2020, 2021, created the problem. Modern monetary theory is dead. You can't put together both stimulative monetary and fiscal. Right now, I'd say we're just right. Given the headwinds that we're facing, but also you have these really, really supportive tailwinds.
And buried a few years ago. Let's just finish on Kevin Walsh and this Federal Reserve. What is the value of an easing bias right now?
Well, at the margin, it is supporting financial markets, no question about it. And so financial markets also help to support economic activity. I don't mind the easing bias. I would be a little bit more concerned if we were actually to get rate cuts with this combo of both stimulative, monetary, and fiscal.
Some people might argue the easing bias right now is dovish enough, given the backdrop we've got.
Arguably, that's what the financial conditions indexes are showing you, given the fact that we have the expectation of some of the biggest IPOs in history on deck, and bond sales are going gangbusters. So, yeah, I wouldn't say that it seems overly restrictive.
What a year ahead. Just a final question. You took a jab at UMich. More than just a jab. That was a three-punch combo. Let's finish on UMich. What is the value of UMich? UMich, once upon a time, drove this Federal Reserve under this chairman to hike rates more aggressively than they otherwise was going to. It seemed to be valuable a few years ago. Why is it no longer valuable?
Well, it surveys only 1,000 consumers every month. We have a daily consumer confidence survey. We survey 500 consumers every day. I pay a professional polling company to do this. We survey 10,000 consumers every month. The Conference Board is, I think, closer to 3,000. Their sample size is just too small. And so, unfortunately, it is a misleading indicator.
What does your indicator tell you right now?
Our indicator has come down to the same level it was during the government shutdown. Kind of in line at the COVID low, way above the GFC low. It's the same level. It's higher than it was rather in 2022 when GDP did stall out because you had the oil surge, bond yield surge, and the Fed began tightening. You're way above that. So it's down, but importantly, it's down at the same time unemployment claims are up. I have this. It kind of drives me nuts that the community thinks we're a one variable economy. We're not. Be it oil isn't the only thing that drives growth. Confidence isn't the only thing that drives consumer spending. You have to look at the job market, and claims are telling you the job market's getting stronger.
Nancy, it's good to see you. Thank you.
Nancy
Lazar of Piper Sandler. That felt right. That just feels more right. Does that sit better with you?
100%. I think that that's an accurate reflection of where we are. And I thought that, the idea of productivity and the idea of exactly what's feeding into some of this optimism reflects, frankly, what we're seeing in markets right now. It seems like a more realistic take.
What we're seeing right now is markets down just 0.1% on the S&P 500 with an update on stories worldwide this morning with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. U.S. Treasury Secretary Scott Bessent is heading to Asia for meetings in Japan and South Korea. Bessent will meet with Japan's Prime Minister and China's Vice Premier before meeting with President Trump in Beijing for his summit with Chinese President Xi Jinping on Thursday. Alphabet is on the verge of overtaking NVIDIA as the world's most valuable company with just $400 billion in market cap between them. Alphabet is taking the lead in nearly every aspect of AI technology. Alphabet recording its best month in April since 2004. And Cerebras is boosting its IPO, now targeting up to $4.8 billion. The AI chipmaker raised both its share count and price range as demand surges. Orders are already more than 20 times oversubscribed, and that could value the company at about $34 billion. That's your Bloomberg brief, John.
The demand endures, that's for sure. Yahara, thank you. Appreciate it. Up next, we'll set you up for the week ahead. Plus, we'll catch up with Jessica Noviskis of Marquette Associates with stocks holding near all-time highs. Live from New York City, you're watching Bloomberg TV.
I would have said that by now we would be in more serious trouble than we are. People have been saying one thing and doing another. So the spending has been coming through. Retail sales have been strong. You've seen reasonably good hard economic statistics versus the soft data stuff.
That was Sarah Hunt of Alpine Saxon words on this epic bull market run. Equity futures this morning pulling back just a little bit. We're down by 0.2% on the S&P, on the Nasdaq down by 0.25%. We've talked about the move in crude, just not a big one. It's 3%. It's 98 on WTI, on Brent it's 104. This could change once the president outlines his next steps, whatever those next steps might be. But as things stand, all we know so far is that the proposal coming from the Iranian side is, quote, totally unacceptable. And that's about that. All everyone else thinks now from this market is that the president is committed to de-escalating and wants to stay on a diplomatic path. If that changes, this will change. But that hasn't changed this morning.
That's the key to me, exactly that both sides seem to be committed to this idea of remaining on a path to de-escalate. If the bar truly is getting that much lower for military escalation, perhaps after the summit between Xi Jinping and President Trump, does that shift? And how much will the market respond then to some sort of military action?
Headlines like this aren't helpful. It comes from Iranian state media that Iran says it's deployed deep roaming submarines through the Strait of Hormuz. You know, those kind of things are not going to encourage risk appetite too much.
You would assume, although there have been a lot of headlines and it's unclear exactly what that would be. Nonetheless, submarines to try to stave off any of the traffic or potentially push out the blockade. The blockade itself isn't something that can just remain in a static way. It itself is somewhat controversial, particularly for Iran.
The squeeze continues. It continues to push yields higher as well by 3 basis points. Two's at 3, 91.60 going into this week, a big week ahead. Tomorrow, we've got CPI data. That's the big event tomorrow morning. On Wednesday, PPI. On Thursday, the president catching up with the Chinese leader Xi Jinping in China with the Chinese president. On Thursday, also, some economic data worthy of a mention. Retail sales and another round of claims. And on Friday, a bit of a milestone, a landmark, if you will. The president on his way, the chairman on his way to the exit at the Federal Reserve. Chairman Powell steps out, and you end up with Kevin Warsh stepping in and keeping Chairman Powell as Governor Powell as company for a little bit.
So, number one, will Kevin Warsh actually be confirmed in time to take the helm as Fed chair? And what will a Kevin Warsh Fed look like? Yes, people are going to be focused on the fact that Jay Powell will remain on. That's almost a sideshow, though, to exactly what is the framework coming from the new Fed chair.
It's a conversation for later this week. In the here and now, 40 minutes away from the opening bell, equity futures shifting just a little bit lower. Jessica Noviskis of Marquette Associates writing, now AI is the focus once again. Markets and the economy are fragile and vulnerable to a crack in the story. The sell-off could be bigger and sharper than those of the past. Jessica joins us now for more. Jessica, welcome to the programme. There were a couple of words in your note that jumped off the page for me, rational and discerning. How rational and discerning has this market been?
It's a big question. We've seen perpetual market strength. We've looked through worst case scenarios. We are entirely pricing markets off of the good things that are happening, the earnings, and we are ignoring the risks and the war and the potential for inflation and maybe rate hikes. I think the market can last this while for until they can't, really, which is a really hard way to trade markets.
Where do you think in stocks right now we should be pricing the tension in the Middle East?
Yeah, I think with the ceasefire, the proof that we had last week that really no one is looking to escalate this, I think that gives the market sort of credibility to look through this. And I think they're really empowered by the Fed looking through this. The Fed maintained their easing bias. So why shouldn't investors sort of maintain that same outlook? Then you pair that with very strong earnings, with the AI story roaring back, huge numbers of CapEx, huge earnings. And I think there is enough good to look through when that's the market's bias from the start. I do think that they are failing to price in any risks, which either works or it doesn't at some point.
How do you price in risks, Jessica, at a time where earnings are coming through in a really positive way, fueling this belief that right now the haven might be in some of these tech names?
I think the haven certainly is in the tech names. And I think that that is fair. I think that this AI story is real and the spend will continue coming. You are expecting that there is a return on these investments at some point, that this continues to develop in the way that it is. If it doesn't, and I am not smart enough to call the crack now, but there's a few different ways that we could see a hiccup in the AI trade or a crack in the AI trade. And then I think that becomes a really big issue. I think it's hard for markets, though, to prepare for that, to do like a weighted average base bear bull like we used to do in the old days. I think that that is sort of not an option if you want to continue to participate in market trends. So it's sort of play the market's game, but sleep with one eye open, because if we do see the crack, I think it could be really intense given how much momentum has built up in the market.
Does a balanced portfolio look differently today than, say, a year ago as a result of some of the risks that you're looking to hedge against?
Yeah, certainly for us, it's not the 60-40 anymore. I don't think that that provides effective diversification for a portfolio. It's really about integrating alternatives and private markets in a really thoughtful way. You have to be cognizant of liquidity constraints, and you have to really make sure you're doing your manager due diligence, you're locking up capital with these managers. But I think that sort of bringing in those truly different return streams is really critical to portfolio performance.
Hey, Jessica, great to catch up and get an update from you. Thanks for making time for us. Jessica Noviskis there of Marquette Associates. It's difficult to be bearish on this market when you've got the likes of HSBC forecasting 20% EPS growth for this year. That's phenomenal growth for the equity market.
And you've seen similar discussion coming from Laura Cavacina as well as Ed Yardeni. There have been others that have upgraded their forecast for the overall S&P 500 and for tech stocks, even as they push out the possibility of rate cuts. People are pricing in a bull market, and they're pricing in the most possible, the best possible melt up. Then you get headlines like this one about submarines mining the Strait of Hormuz. How will this market respond to a re-escalation given that most people believe that a de-escalation is squarely what's the base case?
There is that much sensitivity. I wouldn't say there is no sensitivity. There is reduced sensitivity to this story. But the moment that headline crossed from Iranian state media that Iran's saying it's deployed deep roaming submarines through the Strait of Hormuz, there was a drop-off in the equity market, but it was about that big. It really was tiny.
And this shows how much people really do have faith that both sides do not really have any benefit to re-escalate. This week's going to be really interesting. And you asked a question earlier today that I think is going to come into the main frame much more significantly. Inflation, yields creeping higher, given the fact that we get CPI, then PPI, and then retail sales, the tolerance of consumers to this inflationary impulse. If you see all of these readings come in hotter than expected, does the yield picture start to pressure some of this enthusiasm?
And the backdrop? A backdrop of uncomfortable calm right now and quiet around the story in the Middle East. Eerily quiet. The president has called the proposal from Iran totally unacceptable, and yet here we are waiting for the president's next steps. And we don't know what those next steps will be. For the here and now, the market's comfortable with the earnings backdrop, comfortable with stocks where they are, happy to go into small caps or rather into semis and a big rally we've had in chip stocks. But to your point, that can change, and that can change through the fixed income channel. Energy up, rates up, story can change.
And through the diplomatic channel, what does come out of those meetings in China later this week, given the fact that potentially China has a role to play in leverage over Iran?
Coming up tomorrow, full coverage of that CPI report. We'll catch up with Russ Kostrick of BlackRock, Ed Yardeni. A big bullish price target from him. We'll catch up with Ed tomorrow. Elizabeth Economy of the Hoover Institute on China and the meeting in Beijing with the two leaders, and Michael Gapin of Morgan Stanley from New York City. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.